Indonesia Institute flagship program, International Seminar on Central Bank Policy Mix 2022, Central Bank Policy Mix for Stability and Economic Recovery, co-hosted with Indonesian Economists Association. Ladies and gentlemen, today we will continue on session 3 and 4 with more experts and their cutting-edge topics. For session 3, we have Ibu Yati Kurniati, Head of Macroprudential Policy Department Bank Indonesia, and James P. Walsh, Senior Resident Representative of International Monetary Fund in Indonesia. And in the last session, we have two central bank colleagues, Mr. Anand Prakash, Director of Monetary Policy Department, Reserve Bank of India, and Mrs. Butsakon Tirapunyashai, Head of Payment System Policy Department, Bank of Thailand. And last but not least, we have former Board of Governor Bank of Japan, Professor Sayuri Shirai from Keio University that will be joining us online. To moderate the sessions, we have another television profile, Andi Shalini, Economic and Business Anchors of CNBC Indonesia. Andi Shalini has been joining CNBC Indonesia TV as news anchor since 2018. She interviewed numerous profiles, among others, Indonesian governors, ministers, and head of prominent companies. Prior to her current position, she was a social media reporter at the same news channel and public relations at several companies. Andi Shalini graduated from Binus University with degree in public relations. We invite participants to raise your hands for offline participants and online participants to submit your questions to the chat box during Q&A sessions later. Now, ladies and gentlemen, let us welcome our moderator, Andi Shalini.
Thank you, DMC. Assalamualaikum warahmatullahi wabarakatuh. Excellency, ladies and gentlemen, a very good morning. Welcome to the third station of Bank Indonesia Institute Flagship International Seminar on Central Bank Policy Mix 2022. On this honorable occasion, I, Andi Shalini or Sasa, will be the host for this panel session. We invite all the participants to ask questions in Q&A session later, after our distinguished speakers deliver their presentations. For participants at the auditorium, you may raise your hand And for participants who is joining virtually, please type your questions in chat box. Please mention your name, followed by your company or institutions, and followed by your questions. So, as we know, in this time of global uncertainty, implementing policy mix in this environment is certainly challenging. Not only revive from the pandemic, but also facing new challenges. So, in the station, we will be focused on how Bank Indonesia macroprudential policies and challenge on the recovery path of Indonesian economy and how macro-financial linkages coordination in central bank policy mix to tackle those issues. Before we begin this station, let me introduce very briefly our speakers today in this third station. Our first speaker would be Mrs. Yati Kurniati. He is joining me here in Bali at the auditorium. Mrs. Yati Kurniati currently is Executive Director and the Head of Department of Macroprudential Policy, Bank Indonesia. Her responsibility including overseeing as well as undertaking comprehensive financial sector stability assessment and macro-financial linked research as a basis for formulating recommendations on macroprudential policies. Previously, she was the head of finance department. She holds a PhD in economics from University of Indonesia. And I'll introduce as well our second speaker, who is joining me also at the auditorium, James P. Walsh. Mr. Walsh is the Senior Resident Representative of IMF for Indonesia. Previously, he was an advisor in the Monetary and Capital Markets Department. He has also led technical assistance missions on developing monetary policy frameworks and implementing macroprudential policy, and coordinate surveillance work in Asia and Latin America before his current assignment. He got his PhD in economics from University of Chicago. So without further ado, please welcome Mrs. Yati and James. Okay, you may adjust the mic. Well, it's an honor for us that all of you join us today. Good morning, Mrs. Yati and James. Very warm welcome to you. Yeah, well, we know that no country is ready for a pandemic. But the question is, the central bank takes a role to mitigate risk through accommodative macroprudential policies and to maintain national economic recovery. Ladies and gentlemen, without further ado, it's my pleasure to welcome our first speakers, Mrs. Yati Kurniati, to deliver her presentation. Mrs. Yati, your time will be 25 minutes. If you want to deliver your presentation standing, you may use the mic. Yes, so Mrs. Yati, the floor is yours.
Okay. Thank you, Sasha. Honorable host Bank Indonesia, Pak Yoga Afandi, and honorable speakers, ladies and gentlemen, it is a pleasure for me to continue yesterday's discussion on the maintaining on the policy mix to stability and recovery. So I will discuss two parts in this session. The first part is I would like to explain what is the role of macroprudential policy in policy mix in Bank Indonesia and how it responds to the pandemic. And the second part is how we move forward to sustain the recovery process. let me tell you that in the next slide, as an authorities, no authorities can work alone to sustain the recovery. So in Indonesia, there is 4 institutions that is included in Committee of Financial System Stability, that is Bank Indonesia, Ministry of Finance, OJK, and also LPS. So we work together, a concerted effort, to have a policy, integrated policy package for boosting the recovery process during the pandemic. So this is the list of the matrix of policy that we work together. We formulate according to our mandate, ensuring each policy reinforcing each other to boost the economic recovery. So I will more explain on the macroprudential policy. Macroprudential policy in Indonesia has 3 targets. The first one is for intermediation. So it's foster the balance and sustain financial intermediation, and the second one for system resilience, and also to promote economic and financial inclusion. For policy focus on the pandemic, for boosting the financial intermediation, we, among others, we relaxed the loan-to-value ratio to a maximum of 100%, increasing down payment to the housing loan to minimum of 0%. Also, we asked the bank to being transparent on prime lending transparency to increase market competition among the banks. And lastly, we provide incentive for banks who extend credit to priority sector. So the beauty of macroprudential policy, we can introduce targeted policy to a certain target. And for strengthening the financial system resilience, the purpose during the pandemic is to safeguard banking liquidity. We raised the macroprudential liquidity buffer. Actually, in the early pandemic, where a severe pandemic raised in Indonesia, so we raised macroprudential liquidity buffer to 200 basis points. For the conventional bank to 6%, and for Islamic banks to 4.5%. And whereas for promoting the economic and financial inclusion, we issued the macroprudential inclusive financing ratio. It's in line with the target of government target to achieve 300% shares of loan to the UMKM, to the SME. And of course, in implementing all these policies, we work together with OJK and also Ministry of Finance. So we support each other to make the process of recovery smooth. And the next slide. Here, the result of our coordination and also from the policy that we took during the pandemic. So in this web, spider web, the red line is the indicator, the position of indicator during the peak of COVID, and the light brown one is the current period. So we see that Indonesian economy has been gradually recovering, and numerous indicators indicate that we are now doing better than we were during COVID-19 peak condition. So the risk, credit risk has improved. The market volatility also getting lower, and loan and deposit growth has increased gradually, and now it's getting better and better. So the bank has already extended credit more to the private, to the real sector. And the next slide, we see how that's an example of the coordination between the four of us in the Committee of Financial System Stability. That is when we loosen the LTV ratio. It's supported by OJK, who lowered the weighted asset, risk-weighted asset, and also from the Ministry of Finance, who provide the tax incentive and also give a guarantee. That's a result in the recovery process in the property market. The credit growth in the mortgage credit loan has increased, and the housing property sales is also improved better. And this, in line with that, the automotive sales also gradually increase, gradually improve. So, for another policy, which is the transparency in prime lending rate, next slide please, we see that such transparency encourage bank competition. So the rate gradually decrease. Also the new lending rate also, the rate for new credit is also gradually decreased, supporting to boost the lending activities, the lending to the real sector. And for the financial inclusion financing ratio, what we call is RPIM, that's also boost the loans to the micro SMEs. With the recovery that gradually occurred in the private sector, in the real sector, the bank appetite to increase lending also increased. We see here the lending standard has moved from the tightening to the tightening zone into the relaxed zone. That's more provide the convenient condition for the bank to lend more to the real sector. And goes to the slide 8. For safeguarding banking resilience and liquidity, during the worst time of pandemic, we lowered the macroprudential intermediation ratio to 70%. But when the situation improved, then we gradually return back to the level before the pandemic. That is 84%. So when we change the macroprudential policy, we will see the financial cycle. So we see that during this time, we still in the below the long-term cycle. So we still need the accommodative policy. So macroprudential policy unwinding is taken as Bank Indonesia moving from the safeguarding resilience into the boosting recovery and intermediation. And the extension of loan restructuring that has been taken by OJK, it also provide the better condition to the real sector, as they can have adjusting time to tidy up themselves to improve risk profile as the condition gets better. Moving forward, as we work now to foster the economic recovery after the pandemic have subsided, now we face another challenges as the global clouded with geopolitical tension, and there is a supply chains disruption and also food protectionism, etc. That may create another vulnerabilities to the financial system. Then we should be ready to still maintain the stability for the financial system. So we work harder to alleviate the scarring effect to the real sector. So we understand that scarring effect in the real sector may hamper the recovery amid the increasing inflation now and the expectation of policy normalization. Actually, we see here the sales and equity and some indicators in the real sector has improved consistently. However, some sectors remain in scarring. Especially, we may see here that the scarring effect in hotel and accommodation services, and also scarring effect in construction as well as air transportation. These are the three sectors that remain have a large NPL and also loan at risk ratio remain high. Whereas for the scarring effect in household, we still see that the people who have a lower education and age after beyond 40 years old, it's difficult to re-enter to the formal works. So as a policy direction, in order to boost bank lending and promote the national economic recovery, then we use the early framework. First, we will boost the intermediation function. So as I mentioned, that we have a targeted policy. That is, we increase the incentive to the banks that provide to extend credit more to the priority sectors. We have 46 priority subsectors that has been agreed under the Financial System Stability Committee, and we work together to boost this sector to recovery stronger. Whereas for the resilience, to maintain the resilience, there is we still use the 0% for countercyclical capital buffer, and also still maintain the PLM and others in the left side. And whereas for the inclusion, we support the banking sector to reach the target of financing, inclusive financing, that is set when they give the plan to the credit plan to the OJK. And so in short term, as I mentioned that when we set the stance for macroprudential policy, we will see how the financial cycle is. And we see that financial cycle in 2022 up to end of 2024 are below the long-term growth. So it means that we still can use the accommodative policy to support the growth of intermediation. And in the medium term, we enhance the long-term trend of credit to GDP ratio and national lending capacity through financial market deepening, non-bank financing, as well as financial inclusion that will encourage saving and lending. Of course, we will continue to increase the productive lending that will more boosting the economic recovery. Of course, in doing so, we have to work together again. We can work alone as financial system stability is under mandate of for financial authorities. So synergy and coordination. Of course, innovation is needed for stronger economic recovery. So synergy and coordination so as to achieve herd immunity from COVID-19 and reopening priority sector are, we believe, as a prerequisite for the economic to maintain the momentum for economic recovery. Whereas to accelerate the economic recovery, we see here that 5 policy response as a sufficient condition to accelerate the recovery. So we have a real sector transformation acceleration, fiscal and monetary stimulus synergy, financial sector transformation acceleration, also digitalization, and last but not least, we have been start with green economic and finance to ensure the smooth transition toward lower carbon economy. So through synergy and innovation, Indonesia has been able to survive the later use from the COVID, and this should build optimism for further national economic recovery. And in closing, I may say that against all of those changes, although there can be no silver bullet, we must work collectively. We need to do it better so that we could recover together and recover stronger. Thank you.
Yeah. Please give a big applause to Mrs. Yati. Thank you for the remarks, Mrs. Yati, especially on sharing how Bank Indonesia formulating its macroprudential policy and the short term and also long term, as well as how the synergies with other policies, and we must working collectively. Thank you. So I'll move to our second speaker, James. Yeah, we look forward to hearing your views about the global economy current situation and challenge, because as we know, we're not only facing the pandemic impact, but also the new challenges such as high inflation, followed by tightening monetary policy by central banks, as well as what's the best practice or how central banks should respond through policy mix, and how those are a challenge affecting emerging markets, particularly Indonesia. James, your time will be 25 minutes. The floor is yours.
Thank you very much. And thank you very much to Pak Yoga and the Bank Indonesia Institute for organizing this event today and yesterday. I found it very informative so far, and it's really great to see that as part of the G20, we get to discuss these issues globally and see the experiences of different places. So I really appreciate the effort that's gone into all of this, and thank you very much for inviting me. I have a presentation we could bring up. So I'll be talking about macro-financial linkages and how central banks that are engaged in the kind of policies that the Bank Indonesia is engaged in, for example, where they're active across a range of targets and a range of tools, how they can think about those kinds of tools. And this is an area that the IMF has looked into more and more recently. My colleague Chris spoke yesterday on our integrated policy framework, which is a new way that the fund is trying to think about how to bring these policies together and how central banks can act more effectively across the exchange rate and interest rate and macroprudential policy areas of work. So next, please. So I'll talk quickly about where the global economy is at the moment and global conditions around the world, and then a little bit about how we see the situation in Indonesia and how the central bank might respond to the very difficult challenges that we're all facing right now in the global economy. So next, please. So even before the war in Ukraine broke out, there was already a lot of concern around the world about what we saw at the time as a two-speed recovery, where the advanced economies and China had been able to power through the pandemic a little more effectively than some of the emerging markets had been able to do, and especially low-income economies. So what we saw was a very rapid recovery in the advanced economies as they had very large stimulus packages and very rapid pace of vaccinations, and that pushed them closer to full employment faster than many emerging markets and developed economies were able to do. And then the war in Ukraine appears to have further aggravated that trend by pushing global growth down quite a bit and really increasing global uncertainty around the world. So the main revisions to global growth that the IMF did as a result of the war in Ukraine were to Russia and Ukraine themselves, obviously, the parties to the war, but also to the European Union, which is highly dependent on energy imports from Russia, and then we also saw an effect on the rest of the world. But what this means overall is that we were already in a difficult economic position before the war started, and this has now been a little more aggravated. And we're particularly concerned about the fact that the scarring that Buyati was noting in her presentation is particularly notable in some of the low-income economies, and I'll come back to that in a little while. Next, please. So that scarring that we were talking about, that is a particular concern everywhere. So the way we see it is that there was a trend for economic growth before the pandemic. Many countries were able to support growth throughout the pandemic, and we don't see as much evidence of scarring as we do in countries that were not able to support growth as much during the pandemic, either through large fiscal packages or through unusually large monetary stimulus. So these medium-term losses to GDP tend to be very high in, for example, tourism-dependent economies, and they are slightly less in countries like the United States or China that, in the US's case, had very large stimulus packages, or in China's case, got the pandemic under control very quickly, at least in the early stages. A second factor that aggravates this scarring is that we see that indebtedness among companies has really risen over the last few years. Part of this is because central banks and banks in general around the world tried to help their corporate sectors through the pandemic by supporting them with additional loans. But what that means is that coming out of the pandemic, we have a large number of companies with unusually high levels of debt. And our concern about that, in turn, is that the more of these highly indebted firms you have, the longer it can take to have a very strong investment response. So this is a concern that we see around the world, that if countries already are below where they were before the trend, that's one concern about growth. On top of that, we have higher levels of debt. And again, on top of that, that means that it'll slow down the investment response that we need. So again, we are in a difficult growth position at the moment in the global economy. Next, please. So the war in the war in Ukraine, unfortunately, has also pushed up global inflation by leading to much higher commodity prices than what we saw last year. So some of that has come down recently. Oil prices are off of their highs of a few months ago, but still commodity prices are quite high around the world. So this has particularly pushed up inflation in a lot of countries that are either large commodity importers or that are large importers of the kind of foods that were previously exported by Russia and Ukraine. So Indonesia has so far been a little more insulated from that than some other countries have. I'll come back to some of the reasons for that later. Part of that is because of the composition of food here, and part of it is because of fuel pricing issues. But around the world, we do see that inflation has been rising in Asia. So next, please. And in addition to these concerns about inflation, we are also concerned about GDP growth in Asia. So while Asia does not have so many strong direct trade linkages to Ukraine and Russia, There are other factors going on in the economy that I'll talk about in a second, and that have led us to revise down growth, namely concerns about the Chinese and US economies. So what this means is that in the last 6 months or so, we've taken a position that was already not great coming out of the pandemic. We've revised down global growth because of a number of concerns, and we've now begun to revise up inflation quite substantially as well. And with the new inflation data this week in the US, it looks like this hasn't yet turned a corner. So next slide, please. So the high inflation that has really taken root in the United States, but also in Europe, has led to higher interest rates in those countries to try to bring inflation down. So this tightening that's underway has led to a tightening of global financial conditions in the US and Europe, which is important to begin to bring down loan growth, bring down demand, and try to bring inflation back to central bank targets. But as we all know, none of those developments stay in one country. There are always spillovers to other places. So these higher interest rates have begun to have the effect of pulling funding out of emerging markets and back into some of the advanced economies. So that has led to a stronger US exchange rate. We've really seen a depreciation of the rupiah here, for example, recently. And that's happening in quite a few emerging markets around the world, with the US dollar in an unusually strong position against almost any currency you can name. Parity against the euro, very low positions for the yen and the Indian rupee as well. So next slide, please. And as I said, these higher interest rates, particularly in the US, we do tend to see that they spill over into Asia. And we can already see a little bit of that in Indonesia. So the way that we would think about this is that a higher long-term rate in the US, and it is important to think of long-term rates rather than just the Fed's policy rate, but a higher long-term rate in the US will tend to lead to higher rates in Asia over time, just to try to preserve the balance of global capital flows and to maintain a fair allocation of capital around the world. So these higher rates in the US will begin to spill over into Asia. That, in turn, will weigh down on investment. And remember from before that investment is already a little bit depressed by the scarring we've seen in the economy. And third, as I said before, many of the companies that we would be relying on to support a recovery in the global economy have higher levels of debt than we would have thought before. So that will further weigh on investment. So again, this high level of inflation and the higher US policy rates that seems to require, and to the extent that those spill over into longer term rates, they will begin to weigh on an investment environment around the world that is already not so great. Next, please. So now I'll talk a little bit about those financial conditions in particular and some of the risks we see in the global financial system. Next slide, please. So I think we can skip this and move to the next slide. So one thing that's been quite noticeable about Indonesia throughout the last year and a half or so during the acute phase of the pandemic has been that Indonesia's position in global financial markets has been quite stable, certainly compared to a lot of other emerging markets. So every emerging market, basically every central bank around the world, lowered their policy rates over the course of the pandemic. Indonesia's policy rate fell to 3.5% and has stayed there for a long time. Most other central banks have done the same. At the same time, now that the US has begun to raise policy rates, that means that spreads have risen across many countries. Those spreads have risen a little, since Indonesia's policy rate has been relatively stable and other countries have had to raise their policy rates as inflation has taken off. These spreads in Indonesia have shrunk a little bit, while spreads in many other countries have not, because their rates have risen more in tandem. So this is partly because, as I said before, Indonesia is a little more insulated from some of these food effects than other countries are, and it's partly because of the fuel pricing policies here. But that does mean that Indonesia has not yet had the experience of rates really having to rise very dramatically to control inflation or to keep the rupiah competitive with other investments. And the third thing I would point out is that the rupiah itself has been very stable over the last 2 years. We've seen a great deal of currency volatility, certainly in the initial phase of the pandemic, back in March 2020, April 2020, when the global economy was really experiencing a lot of financial uncertainty. But even since then, since that that has calmed down a little bit throughout all of the ups and downs of the pandemic and the global economy. While many emerging market currencies have been quite volatile, the rupiah has been relatively stable. So to some extent that shows that there's quite a bit of confidence in economic policy making here, and it also shows that there's really a consistent message about how the recovery will emerge here and what policies we will see in Indonesia as the pandemic begins to lift. Next, please. So that's the environment that we had before the war in Ukraine started, and since the war began, markets have had to deal with what has really been a striking historical shock. So there are three main things that I would talk about with this, at least in terms of their effect on Indonesia. The first one is how commodity prices, which have really changed quite substantially since the war began, will affect Indonesia. Indonesia is a commodity exporter, particularly of palm oil and coal, but also a commodity importer of oil. So for the moment, the higher export revenues that Indonesia is earning from higher global prices for coal and palm oil are less than what has to be paid for imports of fuels. So we are seeing an improvement in the current account. That is likely to continue as long as we have somewhat higher prices than we would have expected a few months ago. And this also supports revenue growth and has provided the government some fiscal space. Next would be that, next point, same slide. Commodity prices also have an impact on inflation. Around the world, this has become quite a real policy problem for most central banks, and Indonesia is not totally immune from that. But because of the government's decision to keep gasoline prices at their current levels, we haven't seen the same kind of fuel price pass-through in Indonesia that we've seen in some other countries. So while core inflation is rising in Indonesia and headline inflation is outside of the central bank's band, we haven't yet seen very high inflation. And for the moment, certainly, it's in a better position than we see in a lot of other countries. The third effect is the one that's most difficult to measure, and that has been the effect of the war on global risk appetite and global conditions. So while Russia and Ukrainian GDP are relatively small relative to world GDP, Russia's a large economy, but not a major trading partner for most Asian countries. The geopolitical tension associated with the war has affected investor confidence and again further weighed down on a recovery that we were already a bit concerned about for the reasons I mentioned before: higher debt among companies, scarring, and tightening US monetary policy. So next, please. Just to talk about two of the other big risks for the global economy, the slowdown in China is a serious concern. So the Chinese economy did very well in the first 2 years of the pandemic, but the zero COVID policy, now the dynamic zero COVID policy, have made it a little more challenging to try to keep the economy humming as the virus has become more contagious. So retail sales in China, in contrast with some other countries over the last year or so, have really been slowing as the country has responded to outbreaks of COVID by having to lock down different parts of the country. Again, the pandemic doesn't happen in a vacuum, and even before the pandemic, the Chinese authorities were concerned about rapid credit growth and in particular risks related to the housing sector. So while growth was held up quite well during the pandemic by Chinese support policies, economic support policies, we do see that credit growth has slowed over the last year, and part of this is an intentional effort by the government to try to reduce risks in the financial sector. And since these risks are particularly concentrated in the housing sector, the housing starts have fallen quite substantially in China. And housing is a big chunk of the Chinese economy, so a slowing housing sector will have quite a drag on the economy. So this concern about how China will be able to continue to implement this dynamic zero COVID strategy as the rest of the world is dealing with high inflation, that will be quite a challenge over the next year or so. So next, please. The other large global challenge and the other biggest economy and the other of the world's two largest economies is the United States, where inflation is quite high and very entrenched now, it seems. So US core inflation continues to rise, or it's quite high already, and the Fed policy rate has risen substantially over the last year. So I think that's not news to anyone. So what I would say about this is that while the U.S. has raised policy rates, if we're thinking about spillover effects on the rest of the economy, it's important to think about these short-term rates, but also to think about U.S. Treasury yields and longer-term interest rates. So the U.S. 10-year yield has also risen quite substantially over the last few months, and the yield curve, the difference between long and short-term yields, has fallen as the economy has come closer to a real slowdown. But these higher U.S. rates are what is really beginning to pull capital out of high-risk investments and out of emerging markets and more into safer havens such as U.S. Treasuries. So next, please. So next I'll talk a little bit about how we see the effects of these risks on Indonesia. Next, please. So Indonesia has done quite a good job of getting through the pandemic, at least from an economic point of view. And here we could see that banks have begun to lend again, credit growth has really returned, and it looks like there's a recovery underway. We can see this both with investment and consumption. Buyati's presentation noted the growth in loans to small and medium-sized enterprises. That's particularly helpful because those are the kind of loans that will help generate employment and really make growth more inclusive and stronger over the long run. So it's very good that we do see growth returning in Indonesia. Next, please. And consumption has also recovered along with investment. As you could see in the previous presentation, again, consumption loans are also rising quite quickly in Indonesia, but we see vehicle sales, retail sales doing quite well in Indonesia. That's also good. And we do not yet see these investment and consumption levels as reaching the capacity of the Indonesian economy. So we still see a GDP gap and not a lot of evidence that spare capacity is beginning to run out, as appears to have happened in many of the advanced economies. Next. It is true that commodities are beginning to push inflation up, even in Indonesia. As I said before, the core inflation remains in the middle of the band, but the headline level of inflation has risen a bit above the band, largely due to food prices and to administered prices. So, in general, central banks pay attention to core inflation because that presents the best signal as to where long-term inflation trends are going. And in Indonesia, core does remain in the middle of the band, but there's reason to be concerned about where things will go in the future. And even though most of this has been driven by food, it still could lead to higher wage demands and perhaps higher inflation later. So the important thing here is to be vigilant, which I'll come back to. Next, please. As I said before, the commodities position in Indonesia has really led to a stronger external position. So it's important to emphasize that while the global economy is highly uncertain, Indonesia is relatively well insulated against a lot of the global shocks that we might be concerned about. The reserve position has fallen off in the last few months, largely due to the recovery in Indonesian imports, but the trade balance has been good throughout the pandemic. The reserves position remains very strong by global standards. So there's plenty of space for Indonesia to insulate against global shocks. Next, please. Higher global rates around the world, in particular in the US, are beginning to affect portfolio flows into Indonesia as into other emerging markets. So particularly in the last few months, few quarters, we have seen further outflows from Indonesia, especially on the debt side. So it's also important to recognize that many of those debt flows are reducing the share of foreign ownership of Indonesian debt, which is now down to 15–16%. It used to be quite high, and that was always cited as a potential vulnerability of the Indonesian economy to global shocks. But the fact that if these foreign ownership share of Indonesian government debt has fallen so much as a result of these portfolio outflows, while it's something we need to pay attention to because we need to make sure that there's financing for new investments in Indonesia, it is to some extent also reducing a vulnerability that we were concerned about before. But in terms of paying attention to where this is going, though, it is worth noting that the spread of Indonesian debt relative to US debt has remained relatively stable, but it has fallen from previous higher levels. So while it's okay from a vulnerability point of view that this foreign ownership share has fallen, it is important to be aware that these spreads they're keeping capital in the country right now, but depending on where US interest rates go, it's important to pay attention to where these spreads go in the future. Next, please. Second, the foreign exchange market is now responding. As I said before, the rupiah had been quite stable for a very long time, but it's inevitable that as US inflation remains high and the dollar has strengthened, at least in nominal terms, against other currencies around the world, this will also be the case in Indonesia. And that has begun to happen recently, where the rupiah has depreciated a little bit against the US dollar, as almost all other currencies have. We also have seen more activity in hedging markets in the last few months than we had seen before. So what this would imply is that while the rupiah has been stable for a while, there is more concern now about potential shifts in the currency. But if you compare this to back in March 2020, when the pandemic was starting and there was a great deal of uncertainty, it's nothing at those levels. What I think we're returning to here is a more normal level of hedging and a more prudent level of concern about where the exchange rate might evolve over the next few months. So it shows that things are returning to normal in foreign exchange markets as they are in the real economy. Next, please. Then just for my last 3 minutes here, I'll talk a little bit about how the fund would advise the central bank, or what the kind of discussions we've had with the central bank on how to respond to these challenges. So next, please. The BI has been raising reserve requirements and begun to normalize its monetary policy stance. That's important because, like every central bank around the world, the BI went to extraordinary lengths to support the financial system during the crisis and make sure there was sufficient liquidity. But now that the economy is recovering, or at least we're in a different phase, we need to think about how monetary policy can be most effective, and it's helpful to that extent to reduce reserve requirements. And I would hesitate to call that a tightening, as we've seen in many other economies, because, as I said before, core inflation remains at the center of the band. It's worth being vigilant about that, but Indonesia's output gap remains relatively large compared to some other countries, and we haven't seen the same kinds of high levels of core inflation that we've seen in other places. So this is more of a normalization than a tightening, though maybe that's semantic. Next, please. In terms of macroprudential policy, here, Indonesia's macroprudential policy framework has to balance this normalization of liquidity that was mentioned before with the continued need to support growth. So what I would say about this is that while the increase in reserve requirements is intended to withdraw liquidity from the economy, macroprudential policies are also designed to encourage lending to sectors such as small and medium-sized enterprises through the liquidity ratios. And to that extent, they can work in different directions. So overall, the stance is tightening. At the same time, the central bank is trying to encourage lending in these priority sectors. And the important thing is to make sure that while that lending is ongoing, that we're still having an overall improvement of liquidity conditions here. And we would appear to have space for that because credit growth has recovered, as I said before, and the capital adequacy position of the banks remains quite strong. So there's certainly plenty of room for banks to lend as long as we're able to keep this liquidity position in a stable trend. Next, please. And third, and this is perhaps the biggest challenge that central banks are facing in many countries right now, is how to think about the exchange rate. So as we see exchange rates weakening against the US dollar, again in nominal terms, since inflation is so high in the US, it's important to think about how should central banks respond to that. So in general, we tend to think that the important thing to do is to focus on maintaining the exchange rate as a shock absorber and allow that shift in the exchange rate to encourage demand to shift from foreign imported goods toward domestically produced goods. It's a little bit of a challenge when this kind of inflation that we're seeing is largely coming from imported commodities. Then it's a little more difficult because those imported commodities may still be imported. After the depreciation of the exchange rate, they'll just be more expensive. But the real concern there, in our view, is that there's a need to focus on making sure that those higher prices caused by higher global commodity prices and potentially by the depreciation do not disproportionately affect low-income households. Indonesia has done a great job over the last few years of supporting low-income households through the pandemic, and they can continue to use cash transfers to do that. I'm out of time, so the next slide I'll go through quite quickly. Next, please. Just to say that, well, it's important to have policy coordination among agencies, And part of that in Indonesia was primary market bond purchases by the central bank. Those really helped stabilize the financial system during the crisis and helped keep banks going through stable interest rates. But at this point, as part of normalizing policies, we should phase those out, which is part of the agreement. And then I think I have one more. Just to reiterate, I liked Bu Yati's slide about the ship with the BI, the LPS, and the Finance Ministry, and the OJK on it. We need agencies across countries to coordinate policies when we're in difficult situations as we are right now. In Indonesia, I think the pandemic showed that there's an effective set of tools for doing that, and we need to continue to do that here and everywhere around the world. And I think that's my last slide.
Well, thank you, James, for the remarks, especially the possible policies that central bank could take and collaboration with others' policies. And James mentioned that Indonesia's economy is fundamentally still stable and well maintained because of the effectiveness of the policy mix. However, the escalation in Russia and Ukraine tension still can influence the growth after the recovery, especially on a higher price, that commodities are pushing inflation upward. So thank you, James and Mrs. Yati, for your fruitful presentation. Well, now we are going to move to Q&A session. For participants at the auditorium, you may raise your hand. And for participants who is joining virtually, please type your questions in chat box. Please mention your name, followed by your company or institutions, followed by your questions, and also to whom your questions is addressed to. Now, I give the chance to participants at the auditorium first to begin this Q&A session. Okay, please. The team will help to give the mic. Okay, for the ladies in center, please. Please mention your name, your affiliation, and to whom you're addressed your question, please, in brief. Thank you.
Thank you very much for the opportunity. My name is Ana Noveria from Institute Teknologi Bandung. My question is for Ibu Yati. Thank you for the very fruitful presentation. And so my question is regarding the communication with the market and also the public. So with amid the soaring food prices, although from Mr. Wells' presentation, it said in Indonesia it's not that high, but I think we've already seen that the food prices also increased by, I think, about 30%. And also the fuel, regarding the fuel prices, it's already announced that the vehicle above 1500 cc won't be able to consume the subsidized anymore. So I think it will also impact the inflation from the fuel prices. So my question is how the Bank Indonesia communicate this with the public, and how to manage the market expectations so that BI macroprudential policy mix still able to achieve its targets. All right, thank you very much.
Thank you for your questions. Mrs. Yati, you may answer.
Thank you. I couldn't hear the name, but from Institute Teknologi Bandung. So there is a policy mix here when the monetary policy is aimed to stabilize the rupiah. So we see here that the increase in prices related to the supply side of the economy. So as James has mentioned, that the monetary policy, so the instrument of monetary policy are effective to the core inflation. So we now hand in hand with the ministry and the local province authorities handle from the supply side. So so we tackle the supply side together with the local authorities, and we also find out. We try to find out what's the obstacle in the market. So together with the local province, the regional offices of Bank Indonesia, hand in hand to handle the volatile food price increases. As for the macroprudential policy, we more attached to the financial sector, particularly the banking sector. So we try to boost the credit to the priority sector, including the sector, the agricultural sector, and those related to the production of food, to ensure that the production sector still can provide enough supply to the market. That's.
Okay, thank you. Boost the credit, particularly agriculture sector. Thank you, Mrs. Yati. Next, I will still give the opportunity to the participants at the auditorium. Yes, please give the mic.
Yes, thank you. My name is Aswin. I'm from the UPN Veteran Jakarta. I have a quick question to Mr. Walsh, James. James, what do you think if that...
Please closer your mic.
Yes.
Thank you.
The Fed has been already increasing the interest rate, maybe up to 2024. And there are also some comment from the analysts that the U.S. will not going to have a recession, that it will going to have a soft landing, something like that. So what do you think the impact on Indonesia itself, if the scenario is that the U.S. is not going to have a recession? That's all. Thank you very much.
Thank you for questions. James, please answer.
So
Closer, please, to the mic.
There are two things to think about, I would say, and how the U.S. economy affects Indonesia. The first thing is that after China, the United States is Indonesia's second largest trading partner. So higher growth in the U.S. means more demand for Indonesian exports, which is good. So if the U.S. manages to engineer a soft landing rather than a recession, that higher growth would be good for Indonesian exports and help strengthen the economy here. The other side is more complicated and probably more of a worry. That's the financial sector side. The linkages between the U.S. and Indonesia are quite strong through the financial sector, both because of capital flows that go back and forth, but also because of how investors price assets around the world. So there, it's a little more difficult to think of what the different scenarios would be, but the concern would be that if there's a high level of risk associated with the U.S. economy, then people will look for safe haven investments, which would push them into away from higher yield assets such as Indonesia's. So to the extent that investors become less concerned about a recession and more confident that a soft landing will emerge in the U.S., then that would probably mean lower risk premia around the world, and that would also be good for capital flows into Indonesia and global interest rates. And then, on the other hand, if there's more of a concern that the U.S. will go into a recession, then the concern about U.S. growth and concern about U.S. investment throughout that recession would lead to higher levels of risk aversion and thus more of an adjustment in global financial markets around the world.
Well, thank you, James. I'll give one more change to the auditorium before I move to the virtual participations. From my left side, please, on the left.
Thank you for the opportunity. I'm Guna from Universitas Islam Negeri Mataram. Okay. This question to Bu Yanti and maybe for Mr. James is about restructuring policy. The data I quote online, this is the increase of net profit from the bank industry in Indonesia, DKI 45% year-on-year increase, BRI 75.5% year-on-year, Mandiri 300% year-on-year, or 10.8 trillion rupiah. What I want to point out is, during the pandemic, the customer or the debtor business experienced a drastic decline and even went bankrupt. But on the other side, the bank industry experienced a significant increase in net profit. How could it be? For me, this is the old condition, because never been done this before. Is this the success of the restructuring policy, or the pandemic condition forced the banks to be more efficient? Thank you.
Thank you, please.
Okay. During the pandemic, so banks itself have, as a corporation, has also have to maintain have a profit motive, or have to sustain the corporation itself. And during the bank itself during the pandemic faced the increased risk. So they have to make decision when. During the pandemic, the NPL, the credit risk, rising so high, and also the loan at risk also skyrocketing. So they become more prudent when they would like to extend credit, and they have to during that. Then, on the other hand, the demand for credit during the pandemic also very low, since there is a scaring effect from the real sector. So when there is less demand for the credit, then banks have to adjust their portfolio. So that's why during that period, the demand for government bonds holding in the banks increased. So that's not because the bank itself do not want to lend to the real sector, but there is no demand during especially in the severe pandemic period. So the increase in the net margin during the pandemic is because they manage their own portfolio. They have from yield, they have from the global, from the bonds and other financial assets. But now, since the conditions getting better, and the real sector is already moving, improving, then there is an increase in demand for credit, and since the liquidity in the bank itself is quite high, then now when there is a demand, then bank itself now extend credit. And for your information, in this July, the growth of credits reached 10.6% high. The restructuring credit in the bank itself actually has given opportunity for the real sector, for the corporation to manage the credit profile. For instance, they can extend with the agreement, they can extend the length of the credit, and with lower interest rate. So it's good for the bank, for the corporation. So now the volume of credit restructuring is already going down, and NPL is also improving. That's create the conducive condition to support for more credit to fueling, more financing to fueling the economy.
Okay. Thank you, Mrs. Yadi. Well, due to high enthusiasm from participants for asking questions, I will give one more time a chance for participants at the auditorium. Please, on my right side, please, for ladies behind. Yeah, thank you.
Thank you very much for the opportunity. I am Tora from Bank Indonesia, Jakarta. My question is about geopolitical tension. I would like to ask Mr. Walsh to answer these questions. So geopolitical tension, in the explanation from Walsh before, will also influence growth look through main uncertainty that push risk perception. However, the trade linkage of Indonesia and Russia and Ukraine is not that big. Thanks for that. In the situation that the application of the sanctions now has brought based and to date, it will be impacted the energy sector or commodity prices. Of course, it will affect to the energy disruptions in the long term. As part of the emerging markets, Indonesia, although we can see always has been so robust in fundamental and also financial stability, but the risk perceptions as a whole in the emerging markets usually so vulnerable. So the question is, how big will be the impact of these geopolitical conflicts to Indonesia in terms of the risk perceptions as emerging markets, especially if the conflict itself longer than been expected? Thank you.
Oh, thank you for the questions, James. The floor is yours.
I can't forecast where the conflict will go and how long it will last. For the moment, it does seem that news from China and its issues with COVID, and from the United States and its issues with inflation, have more of an impact on commodity prices and on the markets, or at least on day-to-day changes, than the situation in Ukraine does. Though obviously the high level of commodity prices that we see around the world is partly pushed by what's going on in Ukraine. It's not clear how long the war will last, or what kind of long-term effects we might see to commodity prices from the war. I'm not sure I have a great answer to this other than to say that there really is a lot of uncertainty in the global economy right now. If the war continues for longer, maybe that would have upward pressure on commodity prices, and we would see $150 a barrel oil, for example. But at the same time, if the US goes into a recession, as a possibility from the previous question, or if the Chinese economy slows, then we would see less demand around the world. None of these things happen in a vacuum, and there just happen to be a lot of very large and uncertain situations right now in the global economy. So I think the best thing that countries can do is prepare their policy frameworks for dealing with continued volatility in commodity prices and perhaps high levels for a long time. And it's worth emphasizing that shifting toward renewable energy, especially geothermal in Indonesia, would insulate the country even more from these higher energy prices. So while that's a long-term and not an easy transition to make, it's good for the environment, and it would be good for Indonesia in the long run.
Well, thank you, James, for your answers. Thank you for questions. Now I'll move to online participations. Please, I would like to mention the questions from chat box to Mr. James from Advis Budiman. Is the inflationary pressure expected to be short-term or long-term? Do you see the current inflation rise is more due to supply-side causes? What do you think of that?
Well, I think it's pretty clear from the points that we've all been talking about with food that a lot of the pressures in Indonesia right now are these global commodity price pressures that are spilling through into Indonesian inflation. So to that point, these are supply shocks that are resulting in higher inflation that have to be accommodated in some way. Interest rates aren't going to, higher Indonesian interest rates aren't going to make much of a difference when global wheat harvests are weak and where it's difficult to get wheat around the world because of the situation in the Black Sea. So yes, to some extent these are supply shocks that will have to be accommodated, and I don't know whether that's short-term or long-term. Prices are high. They could stay high for a long time or they could continue to rise. So that's the first thing. Yes, a lot of this is supply-driven. In terms of how long it will last, what matters is to what extent these inflation trends become entrenched in Indonesia. So at the moment, there's an output gap. We don't yet see that Indonesia is running up against the capacity limits of the economy. We do see that core inflation has risen. It's now in the middle of the band. It could continue to rise. That's something we need to pay attention to. But so far, there isn't much evidence here, at least, of the kind of wage spiral that you might see and that we saw maybe in the 70s. It doesn't seem like there's entrenched high expectations of inflation in Indonesia yet, so that should give us some hope that this will not be a long-term phenomenon.
Okay, thanks for your answer. Next, I would mention the other questions from online participants. From Lauren from Unica de la Salle, Manado, to Mr. James again. Would having a digital currency help to maintain the exchange rate in relation to the microeconomics conditions in Indonesia? Furthermore, what are the prerequisites or conditions for a country to launch a digital currency? Please, James, to answer.
So a lot of countries around the world are contemplating issuing digital currencies, and some have already gone far enough to actually doing it. I don't think we know enough yet about how it would affect something like foreign exchange markets to make a blanket prediction about how it would really change things. There are certainly advantages to central bank digital currencies if Bank Indonesia were to issue one, and there are disadvantages. One of those disadvantages is just that we don't have a lot of experience yet with knowing how this affects the banking system, how it affects the foreign exchange market, and it's important that we are aware of those risks and that we're thinking about how these currencies could affect financial stability before we make the leap into having a large central bank digital currency. So this is something that is very interesting. A lot of places are looking into it, but I just don't think we know enough yet about to make a great prediction on how it would affect something like the foreign exchange market.
Okay. Next question is for Mrs. Yati from Prajna Gajah Mada University. Mrs. Yati, regarding future challenge for Indonesia financial stability, has Bank Indonesia see any challenges comes from DeFi, or we know as decentralized finance development?
So currently the exposure to DeFi recorded in Bapepti, the authorities that record all the commodity transaction, remain limited. But we do monitor closely the development it is internationally the rapid progress in this transaction. So together also with the Financial Stability Board, so internationally we also preparing ourselves to be able to monitor closely, because the data itself on this kind of instrument is limited. So we work closely with the Bapepti to be able to monitor the progress and preparing how to respond to this such development.
Thank you, Mrs. Yati, for your answer. Next question is still from Prajna Gajah Mada University. For this time is for James. James, for Indonesia, you said that you support further monetary policy normalization and balancing with growth supporting from macroprudential policy amidst imminent rising inflation. how to mitigate potential conflicts between those policies?
So this is a challenge in a lot of countries because sometimes we're trying to support growth in a context where inflation might be at trend or above trend. It can be hard to think about how these policies might conflict with each other. So what I would say is that Pak Solikin's presentation yesterday actually addressed this issue, and one of the ways to think about it is that if we think about high inflation, one response to high inflation could be if we're concerned about high inflation because it's coming from a lack of capacity in the economy and entrenched inflation expectations, then raising the policy rate would begin to bring down demand and begin to bring inflation under control. Macroprudential policy can be used to try to encourage lending, but because it's more directly focused on the quantities of lending, we can think about it from a financial stability and credit growth point of view. So I think what Pak Solikin's chart yesterday suggested in a schematic kind of way was that if we see that inflation is below trend and credit growth is below trend, then both policies can be stimulative. But if we see that credit growth is high and inflation is relatively low, then we might be more concerned about macroprudential policy. So at that point, we might want to use macroprudential policy to bring down credit growth a little bit and reduce the risks associated with to the banks of that credit growth, while at the same time allowing monetary policy to be a little looser. But these are exactly the kind of conflicts that come up everywhere now, now that we're trying to think in a more coherent way about how to combine macroprudential and foreign exchange and monetary policy, interest rate policy areas into one set of policy recommendations. It's a challenging thing to do, and we're all learning from each other around the world right now.
Okay, next question is still for you, James. In the midst of recovery path of the Indonesian economy, do you think greening the financial system is included one of the policy, and what do you think about that, and how's the progress so far?
One thing that the fund has been very concerned about over the course of the pandemic, and this has become more of a concern as commodity prices have risen this year, is that these higher fuel prices around the world aren't seen as a reason to postpone the green transition that we need to try to bring climate change under control. So the greening of the financial system does have to be an important part of the shift toward a low emissions economy and part of the gradual attempts to try to contain climate change. So that's a good question to ask. What we would hope would happen over the course of the pandemic is that we continue to implement measures that will make it easier to invest in green technology and green investments. And Indonesia is like every country, is trying to move in that direction. So there's a few things that I would point out here. There's been an increased effort to try to issue green bonds. The OJK now has a taxonomy of green lending, which is one of the few countries that has implemented this taxonomy so far. And that tries to make it clearer for investors about what kinds of products they can buy that are going to be supportive of the green economy in the future. So yes, this is an important part of the recovery in Indonesia and everywhere around the world, and it's something that we all have a long way to go. But Indonesia has made some important steps, and it's good to continue those.
Okay, thank you, James. And Mrs. Yati, what's your view regarding this?
Yeah. In Bank Indonesia itself, we prepare the framework for green policy. So not only green banking, but we also for the Bank Indonesia itself, we plan later if there is an instrument in greening we can use for the monetary operation. And now we already started with the investing in managing reserve in green bonds, something like that. And we are now the green finance in the banking sectors remain low, but we are moving start to increase. Especially big banks has already. Because that it's still not simple in identifying green project. So now Bank Indonesia, together with Ministry of Menko Marves and also the Environment, KLH, Environment Ministry, preparing tools, the application, the tools that where the corporation can measure the emission, the carbon emission, and that's important as because when they there will be a disclosure, right? Disclosure on a green disclosure, sustainable reporting disclosure that every corporation have to include the production of emission that was generated from the activities. And when the debitor of the banks ready to have such a measurement, it will be easier for the banks to identify whether such sector has a plan toward the green corporation. Then it will be easier for the banks to finance in identifying sectors that have a green. So we're preparing a smooth transition because it's not easy for us to do it. But now we have started together with there is a national work in this area that we both all authorities involved to support Indonesia toward the greening economy.
Wow, that's cool. Thank you, Mrs. Yati. Thank you, James. Unfortunately, we have to end the Q&A session, but let me conclude with several takeaways first. Global growth recovery has been slowing down due to several challenges, such as an escalation of the war in Russia and Ukraine, recent social restriction in China because of zero-COVID policy, as well as tighter global financial condition. Therefore, to mitigate the impact and others' future challenge, Bank Indonesia has been implementing various moves. One of them is continuing accommodative macroprudential policy. And so far, like James mentioned before, Indonesia has been less affected than some other countries due to Indonesia's economy fundamental credibility is well maintained by fiscal and monetary policy mix. So there are some potential response that Central Bank of Indonesia could take, such as Bank Indonesia should continue its normalizing policy while maintaining its accommodative macroprudential policy. So we hope that all those efforts and policy mix that will help Indonesia through recovery phase, recover together, recover stronger. To end this third station, I would like to thank all of the panelists for your sharing your valuable insights for us today. And thank you for participants who joined here at the auditorium and also virtually. Hopefully there are some key takeaways. So Mrs. Yati and James, you may return to your seat. Once again, please give them a big applause. Excellency, ladies and gentlemen, very good morning. Welcome to the fourth station of Bank Indonesia Institute Flagship International Seminar on Central Banking Policy Mix 2022. We invite all the participants to ask in Q&A session later after our distinguished speakers deliver their presentation. For participants at the auditorium, you may raise your hand. And for participants who is joining virtually, please type your questions in the chat box. Please mention your name, followed by your company or institutions, and to whom your questions is addressed to. The pandemic has a significant impact on the global economy. Various countries have been implemented their policy to counter the pandemic. Interestingly, the COVID-19 pandemic has also accelerated the digital payments. And today's world not only facing the triple challenges consisting of high inflation, high interest rates, and weakened economic growth, but also the climate risk. So in this station, we will gain understanding from global experts and countries' experience point of view to address those issues. So before we commence the discussion, let me introduce very briefly our speakers in this fourth station. Our first speaker would be Mr. Anand Prakash, who is joining me here in Bali at the auditorium. Anand Prakash is currently working as Director of Interest Rate Division in the Monetary Policy Department of the Reserve Bank of India. His responsibilities include analysis of interest rate channel of monetary transmission in India. He has experience in various macroeconomic areas, including economic policy research and analysis, foreign exchange reserve management, exchange rate management, monetary operations, and financial market analysis. I'll introduce as well our second speaker, who is joining me here also at the auditorium, Ms. Butsakorn Tirapunyasai. Ms. Butsakorn Tirapunyasai is the Senior Director of Payment Systems Policy Department, Bank of Thailand. She has been working in the areas of banking risk supervision and examination, cybersecurity, and payment system. Currently, she is responsible for driving the development of Thailand's payment systems to promote payment innovation and stability. I'll also welcome our third speaker that joining us virtually, Sayuri Shirai. Sayuri Shirai is currently professor at the Faculty of Policy Management, Keio University. She is also a visiting fellow at the Asian Development Bank Institute, as well as an advisor to Nomura Research Center for Sustainability and Tunisian Oilio Group. She is the author of numerous books and papers on a variety of subjects, including central bank digital currency, monetary policy, global finance, and ESG investment. So without further ado, please welcome to all our speakers in this fourth session. You may adjust your mic, please. Adjust the mic. Well, it's an honor for us that all of you join us today. Good morning, Mrs. Anand, Ms. Butsakorn, and also Professor Shirai join us virtually. We hope that you hear our voice clearly. So I'll begin with Mr. Anand. How was RBI experienced to counter the pandemic disruptions? And what are the issues or challenges that RBI is facing? You have 20 minutes to deliver your presentations. The floor is yours.
Good morning. I'm very thankful to Bank Indonesia for the opportunity, Mr. Yoga Effendi, other participants, moderator. It's a great opportunity. I was given another opportunity in 2018, and all these central bank policy mix events are very thoughtful and thought-provoking, this thing. So here I will be dealing with the RBI experience in managing the pandemic, the outcome of the measures that RBI took, the current liquidity rebalancing that RBI is currently doing, and some of the issues that the Reserve Bank of India is facing and the country is facing, some of the issues and the policy measures that have been taken in the recent period. So that is basically the brief outline of my presentation. Can I have the slides, please?
Please, Tim, to help the presentations. Okay, Mr. Anand, as I mentioned before, we face the pandemic challenges, and how is RBI's view or how to tackle and strategies to counter the pandemic impact?
Yeah, so okay, let me start from whatever I have. When the pandemic struck in 2020, the economy was already in the midst of a tepid growth outlook, and then contracting production of imports of capital goods. The inflation pressures had risen to something like 7.4% in December 2019, and the core inflation was also rising. So this was the backdrop in which this pandemic happened. So when in March 2020, when the country went for a complete lockdown, that was on 23rd of March 2020, the country went for a complete lockdown. And that was the lockdown that India imposed was one of the harshest, and it was very strict, especially during the first 3 months, absolutely no movement. So there was complete supply chain disruption, and nobody was allowed to move except for very essential this thing. So at that point of time, the first thing the RBI did was to have a business continuity bio-bubble, where 150 dedicated staff were kept in a separate facility, in a hotel kind of a thing, so that the basic operations like payment and settlement, foreign exchange management, and these kind of things were not disturbed. So they continued there for they were completely isolated. They were completely isolated, and none of the essential functions of the Reserve Bank of India was interrupted. So there was a time when there was a huge, at that point of time, because of the pandemic, because there was a turmoil in the global financial markets, and there was a large spillover on the domestic markets also. The rupee was also, yeah, that's fine. The rupee was also experiencing tremendous depreciating pressure, and there was a market seizure, there was illiquidity in the market, and the yields were rising in the domestic financial market. So this was the kind of situation when, there was a lot of turmoil in the financial market. So it was very essential at that point of time to take appropriate measures to control the situation. Next slide, please. So RBI took both conventional and unconventional measures to address the situation. The conventional measures included, reduction in two reductions in repo rate, large reductions, and both were done out of the policy cycle. We have bi-monthly policy cycle. So say February, April, June, that kind of a thing. But in March, because of the pandemic, extraordinary policy measures were taken, and the repo rate was cumulatively reduced by 115 basis points. Of course, most of the central banks reduced the repo rate, but this was quite a significant reduction at that point of time. Now, reverse repo rate, we have a corridor system where the repo rate is in the middle of the corridor, and there is a upper band which is called marginal standing facility, which is 25 basis point, and another thing which is fixed rate reverse repo, which was 25 basis point. But at that point of time, the corridor was made asymmetric. So the reverse repo was not 25, it was actually 65 basis point. So this effectively became, the reverse repo rate effectively became the floor of the corridor. So the repo rate was something like 4%, the reverse repo rate was 3.35%, and the MSF rate was 4.25%. So the Reserve Bank made the floor asymmetric, and in fact, all the money market rates were hugging the bottom of the corridor. So the effective reduction in the policy rate was actually quite significant, more than 115 basis points, because the policy, the de facto, the effective policy rate was the reverse repo rate. So the liquidity was, injected through various open market operations, longer-term repo operations, then a cash reserve ratio reduction. CRR was reduced by one percentage point from 4% to 3%. So, and RBI also at that point of time entered into some swaps. I think there were, total quantum of swap in injection. Because there was a lot of turmoil in the foreign exchange market, the RBI entered into sell-by swaps. So something like 2.7 billion US dollar was injected through sell-by swap. And then, of course, the liquidity access to the commercial banks was also increased. MSF is a penal rate. I mean, if the banks have no choice, then they can go to marginal standing facility, which is 25 basis point above. So the access to the MSF facility was increased, 1% more. You can borrow 1% of your NDTL more through MSF. That was also done. And banks were also incentivized to produce, loans to productive sectors. And productive sectors were, something like automobiles, residential housing, medium and small enterprises. So these are, productive sectors with larger linkages. So they were banks were incentivized to lend to these sectors, and the amount of lending would, count for CRR exemptions. So that kind of a thing. Then RBI also entered into a number of unconventional measures, which were long-term repo operations, targeted long-term repo operations. Then liquidity support to the All India financial institutions, which lend to MSME sectors or housing sector and all. So then asset purchase program like government securities and state development loans through GSEC acquisition program, GSAP we called it. And then special OMOs, which entailed simultaneous purchase and sale of securities to compress the term premium, to flatten the slope of the curve, of the yield curve. And also forward guidance, explicit and implicit. The forward guidance was both time contingent, like it will continue till say X period, or state contingent till recovery took hold or till inflation reached a particular level. So all these things were undertaken. Next slide, please. So unconventional, I have already told, a number of long-term repo operations were, LTROs were already introduced in February 2020. But after the pandemic, more was done, and 5 long-term repo operations, equivalent to 1.25 trillion rupee, that was injected through the long-term repo operations. And then in April and in March and April, again 5 TLTRO, targeted long-term repo operations, which were done to provide liquidity to specific sectors or specific segments of the financial market, like mutual funds, NBFCs and all, who were or mid-sized corporates who were facing liquidity crunch. So this was carried out. And this actually there were studies done within the Reserve Bank which showed that this actually improved monetary transmission. It had also significant impact on bond yields. And then another, in this long term, apart from that, on-tap TLTROs were introduced in October 2020 for 5 specific sectors, which was, of course, the ambit was broadened to 26 sectors, and then later non-bank financial companies were also included in that. So on-tap TLTRO, so this was basically for specific sectors, absolutely. And then there were other special long-term repo operations for small finance banks for lending, small lendings. So they were given incentives. They were refinanced by the Reserve Bank at favorable terms, so that they can lend to small, small entities. The key difference between LTRO and TLTRO was that LTRO augmented liquidity, and TLTRO was targeted. So it basically, ensured even distribution of, liquidity among the stressed sectors. Next slide, please. So. I already said refinance was provided to all India financial institutions like NABARD, National Bank for Agriculture and Rural Development, Small Industry Development Bank, National Housing Bank and all, and Export-Import Bank of India. So these refinance was so that they could provide credit to the rural sector, to the small industries, because they were the most impacted by the pandemic. The pandemic, India being a very, a very large country with a very large population, there was a tremendous amount of dislocation because of the lockdown. So to address that, this liquidity support was provided to these all India financial institutions. Then the special liquidity facility for mutual funds, because many times mutual funds face redemption pressures when there's a lot of stress in the financial market. So special liquidity facilities were provided to mutual funds also. Then especially in this thing, in 2021, when the second wave of pandemic struck, there was complete mayhem. So at that point of time, the term liquidity facility was introduced for COVID-related healthcare infrastructure and services, and also for so that hospitals and those kind of things could get easy liquidity, and on-tap liquidity window for contact-intensive sectors like hotels, tourism and all, which were very badly affected. So banks were incentivized to lend, and they could get concessional facilities from Reserve Bank of India. Next slide, please. So, and then there was asset purchase programs, and the difference was that in our asset purchase program, unlike advanced economies, we did not, lower the standard of our collateral. So the only introduction, apart from the government securities, was state development loans. That was introduced. So, OMOs were conducted, and I think more than 3 trillion, this thing, was injected through open market, or more than 3 trillion rupee was injected through open market operations. And then again, government securities acquisition program, which were much larger than OMOs, they were also introduced. So these are the numbers. In Q1 2021-22, 1.1 trillion was injected. In Q2 2021-22, 1.2 trillion was injected, and they were very large, this thing, and they had a positive impact on yield. They brought the yield down. So the difference between OMO and GSAP was that in the case of GSAP, an upfront commitment was given that the RBI would conducting this quantum of this thing. OMOs are discretionary and they are announced, according to the need. But here, upfront commitment was given. Apart from that, there were also Operation Twist or whatever, this was used in the United States, but in the Indian part was that they were a special OMO which introduced simultaneous purchase of long-term and sale of short-term securities. So that way, the long-term premia, the long-term yields got compressed, which of course had a positive impact on borrowing cost for the corporates. And the steepness of the yield curve flattened. It increased the short-term rates and depressed the long-term rates. So there was a flattening of yield curve. Next slide, please. And apart from that, there was also, the RBI provided forward guidance. The forward guidance was an essential component. So like MPC decided to continue with the accommodative stance as long as necessary, this kind of a thing, at least during the current financial year into the next financial year. That kind of forward guidance was provided by the Reserve Bank of India. It's again, when announcing GSAP 1.0, for the year 2000, we have decided to put in place what is termed as GSAP 1.0 under the program. The RBI will commit upfront to a specific amount of open market purchase of government securities. So this kind of upfront commitment, forward guidance was provided to the market, which gave assurance to the market. Next slide, please. How has the RBI's policy response? Again, I have mentioned unconventional measures are taken even before exhausting the conventional policy space. So it's not that we went into a negative interest rate territory or anything like what was experienced by the advanced economies. Here we had conventional policy space available, but we went for unconventional measures. And counterparties, as I said, included only banks on all India financial institutions. It did not include corporates, or we did not lower the quality of the collateral. So RBI asset purchase program confined to central and state government securities, not private corporate bonds or anything like that. These measures were set with preset terminal dates, which they were not open-ended, which instilled confidence. There was a clarity that, okay, by this date, the program will get over. It was not that they were kept open-ended. Solely operated in the secondary market. There was no primary support to the government or whatever. So it was not deficit financing. It was the RBI operated in the secondary market and implemented monetary policy without compromising on price mandate on the primary mandate of price stability. So the price stability mandate was completely, never given up, and that's why the RBI was quite circumspect in, carrying out, in introducing these measures. So the price stability was never compromised. there were demands that, when the government and the RBI should do more, but that, there were, these things were balanced. Next slide, please. So apart from these things, there were some other important regulatory measures which RBI did just to avoid, just to prevent stress among the financial entities. One was loan moratorium, because India is a large country and people were facing problems because everything had come to a standstill suddenly. So loan moratorium was done. Asset classification standstill, because if you are unable to pay your loan or whatever, there was a standstill. This dispensation was provided. Easing of working capital finance and deferment of interest. Working capital finance also was, terms were eased, and the interest payment was, there was a deferment. Then increase of group exposure norms, banks were allowed to, the limits were increased for exposure in a group of related entities for their exposure. And then the restructuring of advances to micro, small and medium enterprises. The restructuring was done just to, help these this micro, small and medium enterprises who were very badly affected. And reduction of the liquidity coverage ratio requirement. Liquidity coverage ratio, if 100 was required, it was allowed 80. You can maintain 80. Then after some time, it would go to 90, and finally it would come to 100. So these were the dispensations which were given to banks to manage the show well and to prevent any liquidity stress. Next slide, please. Then next slide. Outcome inflation, after the pandemic, for 2 months, that was, I think, March and April, April and May, there was no, because everything came to a standstill, it was a very this thing. There was no data collection for, so there was no inflation data collection. So there was nothing, So it was all imputation for that period. Because of the supply and work disruptions, inflation inched up at that point of time. And though now the inflation has eased from the high levels which were witnessed in September 2001, but the crisis in Ukraine and all have again brought inflation to the fore. And right now RBI is grappling with the problem of rising inflation. Next slide. So growth was very severely impacted. In fact, the GDP in the first quarter of 2021, which is April-June 2021, contracted by something like 23.8%. Which was one of the sharpest, or maybe the sharpest decline. The exports actually declined by 61% in April 2020. It remained in contraction during the first half of 2021, but in the second half of 2021, that is, say, October to March 2021, it started, some amount of recovery was witnessed in the second half. Then again, the second wave which came in sometime in March, April 2021, that again dented the, recovery. The real GDP during, it dented the recovery, but the impact was less severe. And in the second half, there was sufficient recovery. So the real GDP actually expanded by 8.7% during 2021-22, which is one of the highest among big economies or major economy. Now, this year again, there has been some moderation, but still it's going to be something like, it's expected to be, something like 7.2%. So exports have also recovered. In fact, in April, during April 2021-22, exports grew by 44.7%, despite tremendous amount of supply disruptions due to Ukraine war or geopolitical uncertainties. But employment is still a major cause of concern. It's still to pick up fully. And bank credit, which had decelerated significantly, has, in the second half of 21-22, started picking up. And it is now in double digit, something like 12% plus bank credit is growing. Next, slide. Financial market outcome, because of these measures, the Reserve Bank could, create congenial atmosphere for financing. And the yield on government securities and the spreads have, declined on corporate bond commercial papers have declined significantly. These have helped in raising more resources through corporate bonds and all. Corporate bonds, corporate sector could deleverage. So, and abundant liquidity was provided. So there was no liquidity stress. Something like 8.7% of GDP was provided as liquidity support by the RBI at that point of time. So next slide. And monetary transmission also increased. So I mean, if you look at this thing, that yellow, March 2020 to March 2022, as against a 115 basis point reduction in the policy rate, repo rate, all these, if you look at this median term deposit rate, it decreased by 150 basis point, weighted average deposit rate decreased by 142 basis point. These are the lending rates. So all the lending rates, if you, against 115 basis point reduction in the repo rate, the weighted average lending rate on outstanding deposit decreased by 131 basis point. On fresh deposit decreased by 159 basis point. So the monetary transmission was very significant. That was also because in October 2019, we had introduced something called external benchmark system, whereas the lending rates were linked to the policy repo rate with some markup. Next slide, please.
Okay, thank you, Mr. Anand, for your presentations. Please give him a big applause. Yes, okay. We will have a Q&A later. Thank you, Mrs. Anand, for your fruitful insights. Thank you also for sharing your RBI's experience of monetary policy implementation to overcome the pandemic, as well as how's RBI monetary transmission during the pandemic, such as long-term repo operations or LTROs and also TLTROs. Well, I'll move on to Ms. Butsakorn. As we know that the COVID-19 pandemic has an effect on most aspects of our lives, including financial inclusion, and it has been brought into focus on the performance and resilience of the payment system. So how's Bank of Thailand payment direction under the new landscape, and what are the future challenges that should be taken into account? Ms. Butsakorn, you have 20 minutes to deliver your presentation. The floor is yours.
Okay. First of all, I would like to thank the Bank of Indonesia to organize the very nice international seminar on the policy mix. I know that you have been organized this for many years, but I think this year is quite interesting topics because we experience it together. And also thank you to invite Bank of Thailand to share our experience on this. And actually this is my first trip to Indonesia, and I'm really impressed for the nice beach and nice weather, and also the greenery of the Bali. And I think that after the COVID-19, I think many countries also have the economic slowdown, and we have to recover our economic. So I think the payment is one of the important mechanisms that would help to drive the economic recovery after the pandemic. And during the COVID-19 pandemic, we have learned that the payment, digital payment is accelerated because people behavior, they change from the traditional payment to the digital payment. And this is our important thinking, that how could we keep this momentum to drive the digital payment as the main choice for the people, because digital payment is quite efficient and also help to increase the inclusion. So however, there are still many challenges that we have to overcome in order to do this. And I think that lead Thailand to think about it and try to reposition our financial sector landscapes and also the direction of the payment in the next 3 years. So today I will share with you on how we have been for the payment, what we have done, and what we're going to change for the next 3 years, and what we think about the future of the landscape. Next slide, please. I think before we are going further to what we're going to do next, according to the take the factor of the COVID-19, I would like to share you the current landscape of the Thai payment. Next slide, please. Our current payment landscape, if I lead you to see at the two dimensions, the first dimension is the channels of payment. You can see that we have the from wide range of the channels. From traditional one, we still have the branch payment, ATM, EDC, machine payment, and also we have the internet banking via computer, and the popular one now is the mobile device or mobile banking. And the other dimension is the payment service. In Thailand, the payment services have a wide range from the wholesale payment to the retail payment. We have the many types of payment service from cash, check. We also have the card and non-card payment services. But the popular one is the retail payment that we use on PromptPay or our faster payment based on the QR payment and also the transfer money by using the PromptPay. And also we have the bulk payment for business and high value payment using the central bank system, or we call botnet. And also we still have the debit card and credit card services, and also the e-money and the prepaid card to provide to the Thai payment system. However, even we have the existing payment landscape with variety of channels or variety of services, we still have the many challenges to develop that in the long run. What the challenge that we face today is that we face with the new technologies, disruption. We have the new service providers that come into the market, and we find out that the business model of the service provider have changed all the time. And now we can see that there is also the new demands from the consumer and from the businesses, and we perceive that there are some new forms of money. We are starting to see that people want to use the digital asset or digital currency for the means of payment. And what increasing with the digital payment is also the fraud and cybercrime that we have to face with it. Next slide, please. And if we, next slide, please. And if we link the digital payment to the COVID-19 pandemic situation, what we have done during the past 3 years. At the first start, when our country was locked down because of the COVID-19 pandemic, we tried to encourage our people to use the digital payment in order to decrease the risk of infection of the COVID pandemic. So during that time, we have learned that the people use the digital payment increasingly. And what we have prepared on those days is that try to ensure that the payment infrastructure system and banking system are well enough to have the infrastructure availability, and also to lift up the cyber security, because the cybercrime and fraud may come with under the situation that people are frightened with the COVID-19 pandemic. However, there are some people that still want to use cash, so we have to do the cash management as well. The difficult one is how to fill the cash in the ATM system, because in the ATM machine, because during the lockdown, filling cash to ATM machine is not easily. So what we have done, we did the collaboration between banks to help each other to fill in the cash into the ATM machine to ensure that when people need to use cash, they can have that available in the ATM machines. And also, as the regulator, we also relax some of our regulation during those times because we want banks to have time to manage the crisis. So we relax many regulations, especially reporting regulation that they have to submit to the Bank of Thailand. We relax and extend the periods for them to extend in submitting the report. But after 2 years of COVID, we got the slowdown of economy, like I said before, and our government starting to promote to stimulate the economic recovery. And what the government have done is that they create a government wallet that we call Pao Tang. We don't have the English here, but we have the in Thai word. Pao Tang in Thai is mean that money pocket or money bag. And government did this wallet in order to promote people to have the campaign to support them during the economy slowdown. The government launched 2 campaigns of these. The first one launched the 50-50 in Pao Tang wallet. It means that when people buy the food or service from the shops that join to the campaign, they pay only a half, and the government will pay the other half. And the second campaign is the travel together. When people go to travel and when they reserve, book the hotel or the air ticket, the government will pay for them for 40%, and they will pay only for the 60% rest of the price. These 2 campaigns is quite popular and widely spread use of people. There are people who have this wallet for 40 million of people, of Thai people. That's more than 60% of our citizens. And millions of shops has joined with this campaign, and it's quite successful. And I think this is a very important moment that many people from the street food shop and even the small merchant in the market, in the fresh market, they can use the QR payment and they have the wallet. And this is the big change for people to move from the traditional payment to the digital payment. And our question is that how could we keep this momentum to be to promote to the digital payment? Next slide, please. And you can see from this increase of the digital payment during the COVID-19 pandemic period, that is increased sharply during that time. And I think this is very important that to keep this momentum. And not only the lockdown period that people behavior change to use the digital payment, but also the government campaigns that support to move on this. Next slide, please. And I will show you that what we have done for our payment, for the digital payment. Actually, Bank of Thailand have the have the payment strategy for 20 years. Next slide, please. We have starting on our roadmap in year 2002, and for those 20 years, could you back to the former slide? Former slide, please. No. No, the first one. Before, yeah, before. Okay, this one. And we have done our payment strategy for 20 years. And first 15 years, actually, we have done on the foundation of the payment, mainly like we build a payment infrastructure for domestic. We did the ATM network. We have done for the settlement, central settlement system, and also the check clearing system. And we also build the soft infra law and regulation and also supervision to the payment. But for the last 5 years of the payment strategy, we have done more focus on the digital payment, such as we build a faster system prompt pay, and we also have the QR standard payment, and we also try to promote the inclusion and using of the payment data to promote the innovation. Next, please. And you can see that during those 5 years, the digital payment in Thailand is quite success. We can build up the using of the digital payment, like the transaction of using per person per year increased from 63 times per year to 312. This is 5 times increasing. And the mobile banking payment we use the mobile banking as the first top of the world record. And this is accounted for the 80% of channel that people using for the digital payment. Our prompt pay system is also successful, that we have the 70 millions of people, 70 millions of IDs that register. And also on the peak day, we have the 47 millions of transactions. And average the 30 million transactions for the average day, and about 11 billion Thai baht per day. And our Thai standard QR, we have the merchant points to accept the Thai standard QR is more than 7 million points. And at the same time, you can see that the cash usage or cash activity, like cash withdrawal from branch or ATM, is declining. Next, please. And another thing that we quite success is we are quite active on the cross-border payment connectivity. We have done many connectivity with many countries in the region, like Japan, Vietnam, Cambodia, Malaysia, also Indonesia, and Singapore. And those are mainly on the QR payment. But the spectacular one is that what we did last year on the remittance, it is the world first linkage on the real-time remittance between faster payment of the Thailand and Singapore. It is a prompt pay now remittance. This one is quite successful. You can see the transaction during the past 1 year that increased sharply because of it is quite fast transfer money. It is real time, seamless. You can use it like you use the local mobile banking, and it's also safe and cost effective because the fee of the transfer is cheaper than the existing service that provide. And also this one, the Singapore and Thailand get the central banking awards on this initiative as well. Next, please. And I think if I focus on the Indonesia, last year on the Independence Day of Indonesia, 17th of August, we launched the Indonesia-Thailand QR payment. This link between Thai QR payment based on the prompt pay system with CRIS, the standard QR payment of Indonesia. And I think this is under the project of the Asian Payment Connectivity. And we aim to serve the tourists between two countries, both online and offline. And this is even though now we have the 3 banking service provider from Thailand, and I think about 14 service provider in Indonesia, but the coverage is quite high. And we plan that we're going to have the number of service provider in the near future. And maybe next year, I heard that the Bank of Indonesia already have the BI Fast, and we can connect the real-time payment, real-time remittance between Indonesia and Thailand maybe in the near future. Next, please. And what we change for the next 3 years, I will show you that we have repositioned our landscape. Next, please. In our new financial landscape, we focus more on the digital. How could we leverage the technology and data to drive the innovation based on the concept of the open competition, open infrastructure, and open data. And we also focus on the sustainability because this is a quite important factor for nowadays business. And for supervision, we move our thinking from stability to resiliency. We think that for the fast-changing world, stability is not enough, but we think the resiliency is more important. And at the same time, for the direction of the payment, next slide, please. In the next 3 years, next slide, please. In the next 3 years, we also focus that in line with the financial landscape. We also focus on openness to have the open infrastructure, open data, and open competition for the payment. We will build up more inclusivity to make more adoption on the payment coverage, especially for the digital payment. We will keep the momentum of the government wallet, and we try to use the digital payment with the public transportation. And at the same time, we will also do the literacy for people, try to make them have the knowledge and awareness of using the secure payment. For the resiliency, we will do more on flexible side to the regulation and supervision. We are more focused on risk-based and proportionate of supervision. Next, please. And I would like to highlight some of the open infrastructure that we have the to launch the new infrastructure we call PromptBridge. If the PromptPay is the game changer for the retail payment, PromptBridge is the game changer for the business payment. This one that help the business process to move from the traditional to the digital business process, that it is the end-to-end process, that it helps the business to have the more cost-effective, fast and friendly uses, and it can be reconciled and can be extended to the get the financings of the service, that the business can get the lending from bank easily because they have the digital footprint via this PromptBridge. Next slide, please. And for the our cross-border payment, we think that the expansion is still important. This year we will expand to Hong Kong and India QR payment, and also we will have remittance with Malaysia. Next, please. And for the open data, what we have learning now is about to use the data for the open banking and virtual banking. And I think that use of data is quite important. We will make it more accessibility. And I think the important mechanism to do the open data is the use of the API, and we will build up the API standard. I heard that the Indonesia already done the API standard that called SNAP. And I think Bank of Thailand will also learn from Indonesia that how we can develop the API standard. And come up to the next slide, please. And come up to the final one, that we think what the future of the landscape look like. I will thinking about that our digital world of payment is changing a lot. So we think in the near future, the payments landscape will be the 3 worlds of payment. Next slide, please. Next one, please. We think that there will be the 3 worlds of payment that live together. The first one is the paper-based payment is still existing, but I believe that it will be smaller and smaller. The digital payment is the most important one, that will be bigger and will be the biggest world of payment. But we also have the new form of the world of payment that we're starting to see that there is the use of the digital asset or the cryptocurrency or CBDC as the means of payment. So I think this world is become bigger as well. And this is a quite challenge for the regulator to how to overcome to regulate this world of payment. And I think, last slide please. I think the most challenge is that how can we work together to have the cross-sector, cross-country, and also the cross-region for the collaboration to overcome to this challenge. And I think that the most important one that as a regulator or central bank and also business banks, we have to work together to overcome to this one. Thank you very much.
Thank you, Ms. Busdakon, for sharing your framework. Please give her applause. Thank you, Ms. Busdakon, for sharing your framework, how to maximize the momentum of the acceleration of digital payments, and including connectivity initiatives such as the synergy with other central banks across the country in terms of QR payment.
Yes,
thank you.
Thank you.
So next, I'll move to Professor Shirai that already joined us virtually. Professor Shirai, as we know, climate change is a great challenge to the central bank's mandate as it could potentially disrupt price stability and monetary policy transmission. With how severe the impact of climate change could be to the economy, how the central bank could participate in mitigating the impacts of climate change through green central banking. You have also 20 minutes to deliver your presentations, and our team will help to operate your slide presentations. The screen is yours.
Thank you very much. I'd like to express gratitude to Bank Indonesia Institute for kindly inviting me to this great event. I wish I could attend, but I will speak online. Can I share the screen? Yes. So today I'd like to talk about green central banking. Like this session 3, two speakers also mentioned that we should not forget about decarbonization, carbon neutrality, and actually lots of discussions are ongoing globally and actions are also taking place. So I will talk about this green central banking from general perspective, not on Japan. Next page, please. So let me give an overview about central bank challenges. So since 1990s, we adopted sort of conventional monetary policy, meaning flexible inflation target. So central bank set the price stability target, and the main instrument is short-term policy rate. And then the central banks in the developed countries started to use unconventional monetary easing, especially after Lehman shock, global financial crisis, because central bank reached effective lower bounds. So we adapted to quantitative easing for the guidance. In the case of Bank of Japan, yield curve control, also negative interest rate, and Fed, US Fed adopted average inflation targeting. And the program for us was we had a low inflation, below 2% target. So how to raise inflation was a major issue. And now, since last year, since this recovery process from COVID-19 and globally, we started to face this high inflation. And so I think we have a separate issue now. So now issue is a high inflation, and there's a risk of this anchoring medium-term inflation expectation. So we are now in the middle of normalizing monetary easing. Next page, please. So when we look at the central bank mandate, I think many central banks share the following two mandates. So one is to conduct monetary policy. So all central banks are committed to price stability. In the case of advanced economy, it's 2% inflation target. And on the other hand, the central bank, especially central bank, are looking at a macro-prudential perspective. So we try to stabilize financial system, and then looking at this global, looking at the total banking system. In addition to that, now the central bank are facing new challenges. That is climate change. And this climate change influence this central banking practices through two channels. One is financial stability risk, and the other is through impacting on macro performance, such as GDP and this natural disaster, fiscal risk related to climate change leads to the food shortage. So that leads to the higher inflation. Green inflation means when we do the transition process toward net zero target, many central bank needs, many government needs to adapt carbon pricing, such as carbon tax, emission trading system. So that leads to the high inflation for a period until the government achieve higher carbon prices. So we central bank now have a new challenges. Next page, please. So this is just one example how serious climate issue is becoming to our economies. So this is the data about the amount of global insured catastrophe losses. Now, most of these insured losses are made in advanced economy like United States, Europe, and Japan, and many emerging economies. They haven't have sufficient insurance. So this loss is just for insured, so mostly in advanced economy, but once we include uninsured losses, it will be much bigger. But anyway, the fact is that these catastrophe losses started to take place from around from year 2000, and this magnitude of losses are growing. Next page, please. Now, I'd like to show you what's happening now in global finance architecture. Now, I think you know ESG investor. E stands for environment, S stands for society, G stands for corporate governance. And then those are long-term investors, mainly coming from the United States and European insurance companies and pension fund. And they are, because long-term investors, they are the one who tries to change corporate behaviors and the banking and financial system to make their lending and investment portfolio greener. So ESG investors are making a lot of influence to globally, to Japanese or to Chinese or to Indonesian listed banks and financial institutions and companies. Now, this is one very important global trend. So we start to see this, the impact of ESG investors globally. But at the same time, we cannot forget what is most important to decarbonize our economy is government climate policy. Most of our countries are committed to carbon neutrality, but at this moment, and they haven't come up with a credible climate policy yet. But what government policy and related environmental regulation are the most important. So they are the one who influence this ESG investors' behavior and the banks and companies. Now below that, you can see CB. CB means central bank, and NGFS is a central banks and a financial regulators network located in Paris. And right now, chairman is a governor of Central Bank of Singapore. And so about more than 100 central bank and the financial regulators are participating in this program. And so they prepare a lot of guidelines for the central bank, how to supervise the commercial banks to make them greener. So central bank is a part of government climate policy. So the government policy is most important, but central bank also can support this decarbonization process by influencing banks and financial institutions through changing their supervisory process, making it more greener. And so central bank play very important role on this climate issue. Next page, please. Okay, so this is actually, I got this information from this NGFS. NGFS, by the way, means network for greening financial system. So central bank climate action can be decomposed into five issues. The first one is macroprudential. As we hear from speakers, we learned a lot about macroprudential policies, and this is mainly to stabilize financial system. So here, this is a global standard. We now adapt to TCFD guidelines, and then so based on this TCFD guideline, we ask company and financial institution to make disclosure about the climate change impact on the profitability of the company and financial institution. So also especially for the commercial bank, I think they are asked to do climate scenario exercise. The one difference between regular macroprudential, which was spoken by today's speaker, and what we are talking here is, generally speaking, when we talk about financial stability or macroprudential, we do just look at like 2-3 years, usually related to crisis. But here, when we talk about climate-related macroprudential, time span is like 30 years. So we have to have some scenario up to 2050, and then what will happen to financial system and macro performance. So the approach is very different. But as BIS admitted, climate change is one of very important financial risks. Therefore, central bank have to look at it. So why is macroprudential? And also what many central banks right now doing is how to incorporate this climate change into this central bank's macroeconomic modeling. And so this is a lot of challenges, but I think many central banks started to work on it. Now, third point, this orange color, many central banks hold asset and non-monetary policy related asset. For example, central bank may manage pension fund for their employees, or maybe central bank manage asset on behalf of local government. So they have a various asset. So now it's increasingly many central banks in the world started to introduce environment criteria to this management of those assets. And then finally, this green one is related to monetary policy. It can be divided into two. One is asset purchase, and the other one is credit policy. So asset purchase is, as you know, it's related to quantitative easing. And also many central banks try to intervene in a foreign exchange market to smoothen their exchange rate. So many central banks have a lot of foreign reserve. So I think now central banks started to include environmental criteria to those assets. Now on credit policy, such as the Central Bank of India mentioned this LTRO or targeted LTRO, the environmental policy can apply to environmental criteria can be applicable to this kind of lending. Okay, so those are the broad picture about what central bank can do. Next slide, please. Yeah, so just to summarize about these 5 actions. So again, this central banks how to cope with this climate risk can be divided into 2 things. So one is price stability. So what they do is that there is a primary mandate with regards to monetary policy. So that is price stability. So and then the central bank try to do so. Price stability is most important, and then within this mandate, the central bank started to apply environmental issue to the monetary policy, and so which means the central bank still use short-term policy rate applicable to the whole economy, general way. But at the same time, with regards to credit policy or corporate bond purchases, some central banks started to introduce environmental criteria. Okay, so with regards to financial stability, this is already part of financial risk. So central banks started to do monitoring and ask banking sector to disclose more information. So this is ongoing. Next page, please. Okay, so let's think about central bank mandate. As I said, there's no question, all central bank, the primary mandate with regards to monetary policy is price stability. There is a research by DECO and BODS, and they look at 135 central bank, and they look at what kind of mandate is. We have to think about rationale for central bank to look into climate change. So all central bank have price stability mandate. So there's an issue. So can we include climate change into price stability? As I said, it can lead to the green inflation. It can lead to the food inflation, high inflation. So can we include this climate change as a part of price stability? So, but the difficulty is, say, for example, advanced economy has 2% inflation target. Sometimes, we are not really sure how those climate change related inflation will be reflected in this price stability target. But so one issue is maybe we can, central bank legitimate to work on climate change because it's related to price stability. There is no consensus yet, but there's a growing consensus that we can deal with climate change under current price stability mandate. The second thing, several central banks have a second objective. For example, in the case of UK, they say, okay, so price stability is primary mandate, but the secondary objective is supporting government policy. So if the government is adopting the carbon neutrality, and then central bank should support government climate change policy. So it can be justified by using second objective. And finally, some central bank has sustainability objective directly as a secondary objective, such as Malaysia, Finland, Philippines, Nepal. So we can, so central bank can use this secondary objective to justify the central bank involvement in sustainability. Okay, next page, please. Okay, so let's go back to this central bank's monetary policy asset holding. So many central banks manage foreign reserve. And then, so traditionally, when central bank manage foreign reserve, because it's related to intervention in the foreign exchange market, the most important priority about the composition of asset is liquidity. So liquidity is very important. And then central bank try to look at risk and returns and manage foreign reserve. Now, environmental criteria will be included here. But then I think central bank have to discuss how to include this environmental issue under this management of foreign reserve. Most likely trend is central bank can purchase the foreign countries' green bond. And so that is easier way. That is some central bank started to do it, including China and Japan. With regard to this quantitative easing, basically here we are talking about corporate bond. Now, in the past, like Bank of England and ECB, they focused on market neutrality. So when they purchase corporate bond from market, they try to maintain neutrality. But what ECB and Bank of England are doing right now is that may not be right, because if the central bank just focus on the market neutrality when they buy corporate bond, but most of corporate bond are issued by large carbon intensive companies. So as long as they stick to neutrality, actually they are supporting those emission intensive companies. So it's against against market failure, because now we have a market failure, right? Carbon prices are too low. So it's very lucrative for carbon intensive companies to do this emission, dirty businesses. So sticking to market neutrality cannot solve this problem. So Bank of England and the ECB started to pay attention to the correcting market failure, and maybe market neutrality should be abandoned. Next page, please. Yeah, so the issue is when central bank purchase corporate bond, should they abandon market neutrality? Then some central banks say, no, they should maintain market neutrality because they say central bank should not intervene in this kind of businesses. It's a government job, and it's a micromanagement. And so there is some opposition. Some Bank of Japan mentioned that they are saying they don't want to do micromanagement. On the other hand, there's a growing views among global many central banks. And then, so especially led by European Central Bank, and they say, as I said, then we cannot leave this market failure, and maybe you have to start to cooperate among the central banks' mandate to help the smooth transition to the carbon neutrality. And also, the central bank needs to develop sustainable financial market. So central bank can come in to develop this sustainable financial market. Next page, please. Yeah, so this is a case of Bank of England. So Bank of England, the primary mandate on the monetary policy is price stability, but then as a secondary objective, they say they support government economic policy. So what they did in May 2021, they changed this they defined the second objective by explicitly introducing that they support government policy and then make it environmentally sustainable and consistent with the transition to net zero economy. So by changing this secondary objective, they decided to introduce environmental standard to their corporate bond reinvestment strategy in November last year. The ECB case, they didn't need to change anything with regards to mandate because their EU treaty already have the following statement. So ESCB, Central Bank, ECB, and they have to deal with open market economy, free competition, and then favoring efficient allocation of resources. And here it's related to market failure. So therefore, ECB can start to do green monetary policy under existing mandate. Next page, please. Yeah, so let's look at the green credit policy. So such as this long-term, lending program by central bank. Central bank can introduce this environment policy. But there is some question here. Because central bank, this monetary policy maker, they are not elected through election. And so can, sort of central bank try to influence on allocating credit allocation, right? In line with the greening policy. So the issue is, can central bank do that? Can they be justified? So I think this, whether central bank can come in and then, influence on credit allocation, I think it depends on credible government policy. If the government has a very credible climate change policy like EU is doing, I think ECB can do it in line with government policy. So it's all up to government. So if the government has a very well clear, time-bound strategy, and then I think ECB can do that. In the case of People's Bank of China, it's the Bank of China is belonging to central government framework, and the Chinese government is aggressively working on this reducing carbon emission issues. So the Central Bank of China is also actively working on green monetary policy. Now, in the case of China, the central bank is not doing quantitative easing. So their policies are focusing on credit policy, and they are actively doing credit policy. So they give better interest rate on reserves for the banks who are doing more greening policy, and they already adopted a collateral framework by introducing environment system, and central bank provide these loans to the banks at a low interest rate. If the banks are providing a lot of financing to green project. But I think in the case of United States, it looks very difficult for them to do it, I think there's a lot of opposition, especially from opposition parties, and then they emphasize it's not a central bank job to come in and to influence credit allocation. So this is a very challenging issue, and there is no global consensus yet. Next page, please. So this is, I just want to highlight ECB. It's a leading central bank on this area. So they already conducted this year the bottom-up stress test on the major banking, major banks, and the result came up. So, and then eventually they are going to introduce climate environment to their capital adequacy requirement in the future. And also, they just announced recently that they are going to introduce environment standard when they do reinvestment of corporate bond, because they already stopped purchasing new bond. So they are just doing reinvestment. So they are going to introduce environment tilting approach. So if the corporate if the companies are doing more green activity, they increase weight on those corporate bonds. So also ECB is doing comprehensive approach. So now they are examining how to introduce environment criteria to collateral system and how to introduce haircut system to this corporate bond. And yeah, yes. Next page, please.
Thank you.
Yeah. Okay. So next, please. Yeah, so this is PBOC, just to quickly, so PBOC, they are doing this taxonomy, green taxonomy, and they are very active, so you can look at this screen. I think ECB and the Chinese central bank are two most active central bank in this area. I think last page, please. Okay, so one issue is that, so central bank started to introduce environment issue, but they still maintain just the short-term interest rate as a major central bank policy, and this applies to the whole economy, right? So there will be some issue. So while central bank introduce green monetary policy with regards to credit policy or corporate bond, but short-term interest rate is a conventional. So I think we have to discuss about this issue in the future, but I think it's all up to government credible policy. Next, please, the final page. So to summarize, what I can say is that probably, many central banks like India or other central bank, they introduce green credit policy. They introduce credit policy, and then they introduce QE, but all those are temporary. So Bank of Japan is still doing this monetary policy, and ECB is doing reinvestment, so they can introduce environment policy. But at this stage, long-term credit policy or quantitative easing, many are now trying to unwind. So I guess it's not time for central bank to discuss about how to introduce green policy to monetary policy. So currently, most important focus is given to how to introduce green issue to promote greening of financial system. So disclosure and promoting climate stress tests to the banking system are the most important. And with regards to the central bank non-monetary policy asset, I think there's many central banks, over 20 central banks are already started to introduce the environment criteria to those assets. So there's any central bank can do that. So let me conclude, let me stop my presentation. Thank you very much.
Thank you, Professor Shirai, for the remarks and possible actions that central bank could take in mitigating the impact of climate change through central banking, and for sharing sample of cases of some central banks. So thank you, Mr. Anand. Thank you, Ms. Butsakorn and Professor Shirai for your enlightening presentations. Now let's move to Q&A station. For participants at the auditorium, you may raise your hand. And participants who is joining us virtually, please type your questions in chat box. Don't forget, please mention your name followed by your institutions or company, as well as to whom your questions is addressed to. Now I give the chance for participants at the auditorium first to ask the questions. Please. Okay, please the team to help give him the mic. Okay, for participants who join us virtually, please type your questions during our discussion or Q&A station in the chat box. Thank you.
Thank you very much, Shasha. Thank you very much, Professor Shirai, Dr. Anand, and my name is and Dr. From the Central Bank of Thailand. My name is
Please
Taufik
louder
Dawood.
your voice. Thank you.
Okay, sorry. All right, my name is Taufik Dawood from Syakuala University, Banda Aceh. I'd like to direct my question to Professor Shirai. I'm very interested in the impact of this green financing, green sustainable development on monetary policy. So you mentioned about the purchase on open market operation, but the idea of purchasing green bonds. So I was thinking, considering that this concept is still new, so market for green bonds should be relatively shallow relative to other bond markets. So how would that affect the effectiveness of monetary policy, particularly in developing countries, emerging countries, where the conventional bond market is still shallow relative to the developed countries? Thank you very much.
Thank you for your questions. Professor Shirai, the screen is yours.
Yes. So I think, at this moment, these discussions are led by European Central Bank. So as you said, so I think many emerging economies, they need to deepen and develop their sovereign bond market. And so, and green bond, I think many governments started to issue, but it's very shallow and very small. So, and then I think also this is also same for European countries, but there is a high demand from ESG investors with regards to green bond. So there's a what we call greeny, which means high demand, higher demand than conventional bond. So I think issue is for the corporate bond. I think this is again at this moment for like Europe or sort of advanced economy. But I think in the future, this liquidity issue is very important. So in the case of Germany, what they do is they issue ordinary government bond and then green sovereign bond and together. So like same condition, so same maturity and same coupon, and government. I think government tries to intervene, and then they may ensure compatibility. Because I think green bond is very shallow and small, and so that you can look at Germany's case. That's one way. So still, it's just started, and so. So at this moment, central bank is doing only on corporate bond. So so it's not a negative screening. So it's a tilting policy. So and then gradually they are going to tighten this requirement. So this is over time. It cannot happen every one day, say, because still many corporate sector, they have to have a net zero policy, and then they have to have plan, and so it takes time. So this is a long-term process.
Thank you, Professor Shirai, for the answers. Thank you for your questions. Before I give the opportunity to the participants who are joined virtually, I'll give again the opportunity to the participants who joins us at the auditorium. Yes, please, gentlemen on our left side, please.
Thank you very much. Thank you for the opportunity given to me. My name is Ahmad Shakir Kurnia from Diponegoro University. And my question goes to the speaker from the Bank of Thailand. In 2018, if I'm not mistaken, Bank Indonesia and the Bank of Thailand set up a local currency settlement agreement. It aims to reduce the dependency on using US dollar in the international payment between Indonesia and Thailand. I'm wondering, how do you evaluate to the local currency settlement so far? Is it effective to reduce the dependency on using the US dollar in the international payment, is it effective to help stabilize the baht and rupiah exchange rate? Because if we take a look at the data, the volume of the transaction of the international trade between Indonesia and Thailand is relatively small. So does the agreement have a prospect in the future as it is aimed to reduce the dependency and stabilize the baht and rupiah exchange rates? Thank you.
Thank you for questions. Ms. Butsakorn, please answer.
Okay. Actually, about the agreement those in year 2018, I think that the countries in the region try to promote the local currency of the regions, and Bank of Thailand have done some agreement with some country in order to be settled into the local currency between two countries without using the US dollar, such as we have done also with the Hong Kong or like you said with the rupiah. But however, from the time past, actually this settlement is not directly from my department, but I think that the payment between two countries that we try to do this is that to promote the certain currency between two countries that have the better FX rate in order to be settled. But for the rupiah and the Thai baht, I think that in the future, if we have the more trade and we have the payment as the important mechanism between two countries, that it would help to support to the trade between two countries, and the settlement between rupiah and Thai baht can be create more important in the near future.
Thank you, Ms. Busakan,
Yes.
for your answer. I hope it's the comprehensive answer. Next, please, from participants join us auditorium. Is there any questions? Before I'll give the chance for participants who has joined us online. Okay, later I want to ask Mr. Anand first. How do you see in the midst of economic recovery of the pandemic? Do you think that interest rate hikes is the best instrument to dampen inflations, or what other instrument can be used to dampen inflations while still maintaining people's purchasing power?
You're asking me to. You're asking.
The team, please help the mic.
I don't know. Yeah, you're asking me from India's perspective, right? So, I mean, Reserve Bank of India has taken a number of steps. Inflation is a major concern. In fact, we have a target band of plus minus, plus minus 2, over 4% is the intermediate range. So you can go up to 6 and come down to 2. But right now we have inflation over 7%. And if the inflation remains above the target band for more than 3 quarters, 3 quarters and above, then the Reserve Bank has to give an explanation for deviation and what policy actions. So the Reserve Bank has already increased rates twice, one by 50 basis points and another by 40 basis points, so total 90 basis points. Apart from that, we have, we have introduced a standing deposit facility. So as I talked, as I told in my presentation, we had an asymmetric corridor, which was 65 basis points below the, repo rate. So now that asymmetry has gone. We have introduced a standing deposit facility, wherein banks can, instead of reverse repo, banks can simply park in. So there is no need for the Reserve Bank to give collateral. So that also has gone up. So total, if you look at it, we have increased the effective rate by 90 plus 40, that is something like 130 basis point. So, I mean, this is one thing. Apart from that, the Reserve Bank has also increased cash reserve ratio by 50 basis points. So all these things are essentially because there is a lot of liquidity overhang. And then inflation, of course, is because of high, food prices, and most importantly, because of the imported, because of high commodity prices and crude oil prices. India is a major importer of crude oil. We have actually, 80% of our requirement is being met through imports. So this also puts pressure. So the pass-through of high crude oil prices to inflation is quite strong. So in view of that, I mean, these steps are being taken. And right now also the inflation for June, I think, is something like consumer price inflation is something like 7.1%, which is above the target. I think, but it is expected, things have started improving, the growth scenario has started improving, the crude oil prices are, it's very difficult to predict, but if, they may come down in the second half, so inflation is likely to, improve going forward in the second half of the year.
Okay, thank you, Mr. Anand. I'll move to Ms. Butsakarn. You mentioned previously on your presentation that cybersecurity is one of the challenge. So in your point of view, how central bank strategies to address the threat of the cybersecurity, and how do you see this threat in developing countries?
Yes, actually the cybersecurity is the important activity that the Bank of Thailand put on our main strategy of the central bank. And in Thailand, we have done about the cybersecurity in about 3 to 4 years before. First of all, we try to strengthen our banks to have the good cybersecurity by using the NIST framework of the US. And we have done the gap analysis whether our banks are ready to have their system that including the protection, detection, and also respond to the cybersecurity. And when they evaluate their gaps, after that they have developed their system, process, and also people to be ready to respond to the cybersecurity. And we also set up the collaboration on the cybersecurity because only one bank or one financial institution cannot be well in response to cybersecurity. So they have to set up the collaboration, and we call that the TB search, in order to monitor the cyber threat. And when something happened to one bank, they're gonna help each other in response to those cyber crimes. And also they try to build up the knowledge and expertise of the cybersecurity task force in order to have the people who expert on this area to respond to the cyber threat as well.
Thank you, Ms. Butsakarn. So next, I will give again the opportunity for the participants at the auditorium. You may raise your hands. Okay, later. While during the other participations ask their questions, I would like ask Professor Shirai.
Yes.
I hope you still join us online and
yes.
you still hear our voice clearly. Each country has our own approach towards a green central banking, and the PBOC ranked first among G20 central banks as the greenest central banking. But on the other hand, China is still dependent on coal. So in your point of view, how that country that's still dependent on the coal learn from this issue?
So yeah, so China is the largest emitter of this carbon, and then it's true. And also, but the Chinese government is committed to achieving carbon neutrality by 2060. And then of course, last September, China had this unprecedented electricity shortage. And so after that, to cope with the economic recession, China started to increase coal production again. So that is true. But I think at the same time, when I'm looking at what China is doing toward carbon neutrality, they are doing a lot of policy. For example, China is right now the largest producer of renewable energy in the world, and also the largest producer of the electric vehicle, right? And also when we look at the green investment, including government and the private sector, China is the biggest investor. So while it's true that China has a lot of challenge, they have to do a lot. And what I think Chinese government is trying to shift from this coal to natural gas. That is a first step. In the meanwhile, they are trying to increase renewable energy. And so I think in terms of policy, they are, doing a lot. So right now, China is trying to have a lot of solar and wind power generation in a rural area, and then they have a very, very long transmission network linking from a rural area in the west to the Shanghai or Beijing. So that is a big investment. So when I look at what they're doing, of course there's a lot of challenge, but I think they're one of the government besides EU and UK, which are doing a lot of policies, green policy. So therefore, and then China has its own taxonomy. They call it catalog, green catalog, which means also Indonesia is introduced. I think starting from EU. So they try to classify environmentally sustainable activities. So and then government is doing lots of this environmental regulation, and then they have a clear target about what each local government can, how much each local government can emit in terms of emissions. So a lot of restriction there. And therefore, central bank can come in and they can do very active green monetary policy. So as I said, so they are doing this conditional lending. So when the commercial bank provide financing to the green project, based on actual performance, based on this performance, the central bank, PBOC, provide cheap loans. And also similar thing was adopted by Bank of Japan from last December. And then also they're the first central bank which already adopted this green criteria to this collateral framework. And so I think, there are many very proactive measures are already taken by PBOC. But PBOC's approach is, very different from what Bank of England and the ECB are doing, because the ECB at this moment, they want to focus on corporate bond. And in the case of Bank of England, they are the first central bank which showed how much emission are coming from their holding of assets as a result of QE. So no other central bank hasn't done that. But Bank of England is the first central bank, and this is the second year. They are publishing, temperature rating. So for example, their corporate bond holding is, like at this moment, is equivalent to 3 degree global temperature scenario. So that is very, very forward-looking. So, and also I think Central Bank of Brazil is doing a lot of nature protection measures. So when the commercial bank provide loans, I think Central Bank gives some environment criteria to that, especially for the financing to Amazon forest. So when we look at many central banks, many are already doing a lot. And so I think, Bank of Japan should do much more. Also, many other central banks should do more. But Singapore is taking the lead. That's why the governor of Central Bank of Singapore, Monetary Authority of Singapore, became chairman of this CN Network for Greening Financial System.
Thank you, Professor Shirai, for your remarks. Now I'll go back to Mr. Anand. Mr. Anand, as an emerging market, what do you think are the best instruments in facing the tighten liquidity of the Fed? As we know, the high inflation still continuing in US as the recent inflation is reached 9% and followed perhaps by its tightened policy. So what are the best instruments or strategies as an emerging markets?
I mean, the impact, I think, is common across most of the emerging market economies. In India, we are facing, outflows, and the Indian rupee is currently under significant pressure. So the Reserve Bank has intervened through sell-buy swaps and all. So there is an issue. Mm-hmm. And if this situation, if the Fed keeps on increasing, we will also be forced to increase rates. Mm-hmm. And there will be pressure on the domestic currency, on the financial markets. The bond market rates and others will also increase. So yeah, I mean, it's a problem, and coupled with geopolitical uncertainty, emerging market economies like India or even Indonesia, we are very vulnerable to the vagaries of international capital flows. So I mean, if I give you, just to give you a perspective, the rupee, which was still recently, a few months back, trading in the range of 73 per dollar, 73 point something, now it is nearing 80. So, a depreciation of somewhere in the region of 9%. So, I mean, this is certainly a major problem, and a major problem for, monetary management also. And whether it is Reserve Bank of India, Bank Indonesia, or Bank of Thailand or anything, it's an issue that's affecting all of us. Yeah.
Okay, thank you, Mr. Anand. And Ms. Busdakarn, as we know, during the pandemic, crypto asset is quite hype across the country. In your views, or Bank of Thailand's views, how about the crypto asset would be considered as the future digital payment?
This is a very difficult question because, as I said, that we are, as the regulator, we're still working on these types of assets because we think that when the people use the cryptocurrency or digital assets as the means of payment, we have to make sure that it are stability enough to use as a means of payments. But still at the present that the cryptocurrency or the digital assets still have the risk that we are not quite certain on it yet, and it have the value of the asset is still volatile. So we are still consider what type of the digital assets can use as the means of payment. We are also thinking about the stable coin, and but the stable coin that quite have the fiat to be the backup, and we learn a lot about that, and we are on the working on it, and we think that in the near future, if we are certain with what kind of digital asset that is stable enough to become the means of payment, so we will regulate that digital asset. But yeah, we are still working on that.
Okay, thank you, Ms. Busdakarn. There is a question from the participants who joined on virtually from Atiuka, from Bank Indonesia, to you. And Bank Indonesia, we also have a program on government transaction electronification. Could you share more about your government electronification program on Thailand, and is it considered effective to increase financial inclusion?
Yes, like I said during my presentation, that the electronic or the digital payment can help to support the inclusion, because people who live like far away, or they can like use the technology on electronic to help them to reach the payment services. So we think that in Thailand, our government and also the Bank of Thailand try to promote the electronic payment system, and that we think that it would help to build up the inclusion. But what we have done in accordance with this is also to build up the knowledge and awareness of the people how to use it in the secure way. Thank you.
Okay, thank you, Ms. Musakarn. Next question is from online participants for Professor Shirai from Ella Bank Indonesia. Professor Shirai, kindly give your insight on the transition risk to green economy for small open economies like Indonesia, which has just started to recover from the pandemic. Please, Mr. Shirai.
Yes, thank you. So there's a trade-off between physical risk and transition risk. So if we maintain current policy adopted by every country, it's definitely not enough. So we will face this physical risk. So as we see this unusual temperature, impact on agriculture, commodity prices, and so on. So we have to do this transition approach, but there's a risk, especially for emerging economy, including Indonesia, but especially for low-income country, because as we discussed today, we face this COVID-19 pandemics, and all countries increase the fiscal deficit and public debt to cope with this recession, severe recession caused by lockdown. So now debt is higher, and then this now it's a time to normalize monetary policy. And so, as some speaker mentioned, there's a capital outflow from emerging economies and heading to the advanced economies like the United States. So it's very difficult for a low-income country to cope with this decarbonization. So therefore, as COP26 last November mentioned, the advanced economy are committed to provide finance to developing country, 100 billion. I think they didn't meet it, but they have to meet it soon, probably by 2023. And I think central bank have, I think advanced economy have to support low-income countries. But right now, I work at the Asian Development Bank Institute, and I'm looking at how financing side. For example, there's a lot of money actually in the world. If we look at the side of asset owned by insurance company and public and corporate pension fund, there's a huge money. So when we look at it globally, money is abundant. The problem is that money is not allocated to the right place and to the people and the project needed. So what I'm looking at right now is, are you familiar with blended finance? Blended finance is that, for example, if the advanced country support carbon emission project in, say, Indonesia, there are lots of forests. So the advanced country can provide financing and skill to the project to maintain this forest or to recover the forest so that they can increase carbon absorption powers. So, and then, I think it's better to have this kind of project together with community development. So it's co-benefit. So, and then at the same time, we need to mobilize money from these ESG investors. Because traditionally, some commercial banks are involved in this kind of project, but ESG investors are never interested in because it's too risky, especially after global financial crisis, Lehman shock. There's a tighter financial regulation imposed on insurance sectors and pension funds. So they are reluctant to invest in a developing country and then this kind of project. So right now, I think we are discussing about this blended finance. So including public fund coming from advanced countries, ODA fund or grants, also provided by World Bank or IFC, Asian Development Bank, and also combining money from public money together and then give some risk mitigation measures. so that this ESG investor can come in. There is some action already happening under EU initiative, but also US government did some arrangements such as nature conservation debt swap with Belarus recently, 2 years ago. I think IMF wrote a very nice report on that. So, giving commitment, asking Belarus to commit to the nature conservation. So they have a forest, a mangrove, which is very important in terms of carbon neutrality. And in exchange of this commitment, the US government helped them to reduce the external debt. So that is one approach. So another one is how to mobilize ESG investors. So this is a new trend and which I'm working on. So I think, we can hear more from Indonesian view and emerging economies view, and then how to mobilize this
Professor
kind of
Shira,
money.
thumbs up. So sorry. Thank you for your remarks. It's very insightful. Unfortunately, we have to end this Q&A session. Let me conclude with several key takeaways from Mr. Anand. RBS measures along with stimulus package by government of India contributed significantly to revival to the economy, supported by rising financial inclusion and digitalization. And RBI stance during the pandemic was to remain committed to mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target. And the highlight from Ms. Butsakorn, there has been a significant increase in digital and payment usage. And to respond this, Bank of Thai focused on developing financial infrastructures and digital payment services. On the other hand, some of issues such as cybersecurity, data risk, and insufficient consumer literacy should be taken into account. And remarks from Professor Shirai, there are some actions that central bank can do, such as improving TCFD or Task Force on Climate-Related Financial Disclosures, climate scenario analysis on financial system, as well as adopting the environmental criteria to quantitative easing or foreign reserves, cutting emissions related to printing money and other operations with emission target. To end this fourth session, I would like to thank all of the panelists for sharing your valuable insights for us today. And thank you participants to join us here at the atrium and also virtually. Hopefully there are some key takeaways. Once again, please give them a big applause. Mr. Anand and Ms. Butsakorn, you may return to your seat. Thank you. And next, I hand back to the MC.
Thank you for all speakers for your comprehensive presentation, and our moderator Sasa for leading the session. Esteemed guests and participants, unfortunately we have to end our 2-day seminar on central bank policy mix. And to officially end this seminar, I would like to call upon Head of Bank Indonesia Institute, Bapak Yoga Afandi, to deliver the closing remarks. Bapak Yoga Afandi, the floor is yours.
Honorable speakers, Professor Sayuri Shirai, Professor of Economics from Kyoto University and former member of Board of Governor, Bank of Japan, Mrs. Butsakorn Tirapunyachai, Head of Payment System Policy Department from Bank of Thailand, Mr. Christopher Ercek, Deputy Director in the Monetary and Capital Markets Department at the IMF, Mr. Ihlyok Shim, Head of Economic and Financial Markets for Asia and the Pacific from Bank for International Settlement, Mr. James Walsh, IMF Senior Resident Representative for Indonesia, Mr. Anand Prakash, Director of Monetary Policy Department, Reserve Bank of India, Bapak Solikin M. Juhro, Head of Economic and Monetary Policy Department, Bank Indonesia, Ibu Yati Kurniati, Head of Macro Prudential Policy Department, Bank Indonesia, all my colleagues from Bank Indonesia, distinguished representative of participating countries from the central banks, ministries, and academicians, and all committee members, parties with whom we have collaborated to hold this event. Ladies and gentlemen, Assalamualaikum warahmatullahi wabarakatuh. May peace be upon us. It is an honor for me to deliver closing remarks at the end of this exceptional opportunity of international seminar on central bank policy mix, which is also part of the G20 side events. Thanks to the God Almighty that this year international seminar, co-hosted with the Indonesian Economics Association, in my humble opinion, ran smoothly and successfully. We are very fortunate to have speakers from reputable global institutions such as the IMF and BIS, as well as central banks from Reserve Bank of India and Bank of Thailand. In this regards, I would like to express my sincere gratitude to all speakers and participants who have actively involved in the topics discussed. It is a great pleasure for us, Bank Indonesia, to hold the international seminar in a hybrid method, after mostly in an online format during the pandemic. With participants from multi-organizations within Indonesia and neighborhood countries, both in person and in online platform, this conference has symbolized the indication of growing economic activities and shaping the future ways of learning or conducting international events. From my point of view, this event has delivered its title, Central Bank Policy Mix for Stability and Economic Recovery, by providing essential knowledge regarding the conceptual, framework of thinking, empirical, and practical aspects of central bank policy mix. Equally important, the discussions are very fruitful in giving our understanding on the implementation of central bank policy mix in response to current challenging economic recovery and future challenges. Ladies and gentlemen, as our Deputy Governor underlined, Pak Yuda Agung, we are now confronting serious challenges post-COVID-19 pandemic. Global economic recovery is being halted by escalating geopolitical tensions, devastating climate change impacts, and ongoing global supply chain disruptions. The challenges are more complex as global inflation rises, while several advanced and developing economies accelerated monetary policy normalizations. Stagflation is imminent. This challenge unmistakably demands a more holistic way of thinking on the formulation of policies. Changing strategic environment and unprecedented global economic dynamics requires optimal exit policy. With that regards, the central bank policy mix is not only conceptually coherent and operationally implementable, but also quite flexible for navigating the central bank in the face of future challenges. From yesterday's sessions, Bapak Solikin stated that to support the optimal exit strategy for stronger economic recovery, the demand-side management strategy, the short-term one, should be integrated with supply-side management to address cyclical and structural problems. This means that central bank policy mix framework remains valid and needs to be expanded with other related policies with regard to maintain macroeconomic stability. Strengthening policy synergy between central bank and government is a sufficient condition in maintaining the momentum of economic recovery. Mr. Eshek from the IMF also underlined the need of integrated policy framework, the IPF. The framework needs of suiting a well-measured approach on related issues in integrated, timely manner is important. Policy rate and exchange rate flexibility may not always be satisfactory, especially in the case of frictions and vulnerabilities that many emerging market and LICs countries have. In my presentation, I suggested that to maintain external stability, we need to enhance not only the policy mix framework itself, but also policy innovation and policy synergy. In the case of Indonesia, we developed instruments such as triple intervention, the NDF and LCS, to maintain exchange rate stability. Ihliok's presentation conveyed the need of using foreign exchange-related macroprudential instruments to maintain external stability. CFMs can also form part of Macro Financial Stability Framework, MFSF, to complement macroprudential policies and FX intervention in addressing the challenges from global financial condition. He also mentioned that some tools require coordination with other regulators. Distinguished speakers, ladies and gentlemen, today we have learned about financial system stability and future challenges that needs to be considering by central banks. Ibu Yati's presentation today highlighted that Bank Indonesia used all forces of macroprudential policies to tackle the pandemics. The aim of macroprudential policy particularly is to support growth and maintaining the momentum of further economic recovery. It is very challenging as the macroprudential policy during pandemic has three main focuses. That is, one, to foster and sustain financial intermediation. Secondly, to strengthen financial system resilience through safeguarding banking liquidity. And thirdly, to promote economic and financial inclusion. Jim's presentation, also today, pointed out on the need of a more complete and effective policy mix. Central banks should stay ahead the curve to maintain expectation. He also suggested that central banks should communicate clearly to ensure orderly market reaction. Session 4 generously shared with us the practice of central bank policy mix in other countries. Mr. Parkash shared that RBI has undertaken unconventional measures even before exhausting the conventional policy space during the pandemic. Those policy mix has been able to manage the economy during pandemics. While Mrs. Butsakorn shared a new and challenging area in central bank policy mix exploration, the payment system. In this regards, Bank of Thailand has been developing financial infrastructures and digital payment services to ensure openness, inclusivity, and resiliency under the new financial landscape. She emphasized the need of balancing innovation strategies and risk to win a changing environment. As for the last, but absolutely not the least, the seminar is beautifully ended by the awakening presentation from Professor Sayuri Shirai. Green central banking is a certainty. Professor Shirai's presentation elaborated the consistency between price stability mandate and environmental stability, although it depends on the government's credible climate policy. With that note, I think Professor Shirai pointed out that central bank should have a strong policy synergy with the government and other related parties. So to conclude, from my point of view, all the presentations and discussion accentuated that the enhancement of policy mix framework requires collaboration in terms of research as well as in practice. Equally important is synergy and collaboration along with policy communication to support the implementation of the policy mix. Our governor, Bapak Peri Warjio, always emphasizes to have well-planned, well-calibrated, and a well-communicated policy. So distinguished ladies and gentlemen, I hope that what has been discussed in this seminar will be useful for all participants in understanding how central bank policy mix is implemented theoretically and practically in order to overcome strategic challenges and ensure sustainable economic growth. We still have homeworks as some technical refinements are required after the use of various policy tools. Nevertheless, we hope it could serve as a milestone for the future of central bank policy mix. The concept, formulation, and implementation of policy is still a challenging journey. It's still a long and winding road. Wise men said that yet our lessons come from the journey, not destination. So once again, on behalf of Bank Indonesia, I would like to thank all speakers who have presented in person and virtually, to my colleagues who have contributed to hold the seminar, and to all participants. Your presences have been invaluable and without any doubt have helped me make this seminar a great success. I sincerely wish that this seminar could ignite further exploration toward the new paradigm and more practices of central bank policy mix. I would like to close my remarks and officially announce the end of this international seminar on central bank policy mix 2022. Safe trip for the speakers and participants who will going back to your places. So see you in the next Bank Indonesia Institute Central Bank Policy Mix flagship program. Thank you very much. Om Swanti Shanti Shanti Om. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you, Bapak Yoga Afandi. Participants, ladies and gentlemen, before we end the second day, we would like to ask again your kind assistance to fill the daily questionnaire by scanning the QR code on the screen. This is the QR code for day 2. As always, after completing the survey, you will find the link to download today's materials. And if you missed the QR code for yesterday, we're trying to display it once again. This is the QR code for day 1. Once again, thank you to our speakers that came all the way to Bali and all participants for your attendance and active participation. It has been a great 2 days of knowledge sharing, and we hope that this event will be beneficial for everybody, especially on the important issues discussed. After this, we invite you to have lunch at Pechatu Room, the same room that you had lunch yesterday. At the end, on behalf of the committee, I'm Widya Rani Hapsari signing off. We'll see you again at the next Bank Indonesia Institute event. Wassalamualaikum warahmatullahi wabarakatuh. Good afternoon and stay safe.
At the end of 2021, we've paved the road to 2022's G20 presidency, promoting Recover Together, Recover Stronger as its main theme. The first Finance and Central Bank Deputies meeting in the Indonesian presidency has established 6 priority agendas in the finance track that will be discussed throughout 2022. Now, it's time to get the wheels turning. One of the most crucial agenda in the Indonesian presidency is exit strategy to support recovery. COVID-19 has led to a severe global recession. In response, countries have taken unprecedented fiscal and monetary policies to protect the economy. These policies, along with the distribution of COVID-19 vaccines, has brought positive outcomes. Economic activities had begun to resume. Nevertheless, recovery doesn't come as a one-size-fits-all item. Advanced economies are recovering much faster than their emerging markets counterpart, while low-income countries are lagging. The different timings of exit policies can potentially bring negative spillover effect for countries. To mitigate these risks, a well-planned, well-calibrated, and well-communicated exit strategy is needed. Under Indonesia's presidency, the G20 countries and invitees will work together to create policy settings for a smooth exit strategy. Discussions will be held in the working group level as well as high-level meetings. For it is our duty to ensure that emerging from this pandemic, no one gets left behind. Recover together, recover stronger. Against the backdrop of the COVID-19 crisis, tackling the economic and financial impact of the pandemic is a matter of utmost concern, particularly for the most vulnerable countries. As the world continues to navigate the exit from the pandemic, the resilience of international financial architecture has been tested. Financial stability risks have been contained so far, reflecting the ongoing monetary and fiscal policy supports that have fueled global rebound. However, the uneven global recovery and the uncertainty surrounding the path of the pandemic could pose risks and exacerbate vulnerabilities to financial stability. Such circumstances could impede economic recovery toward a strong, sustainable, balanced, and inclusive growth. The G20 plays an essential role in maintaining recovery momentum by ensuring global financial stability and safeguarding it against negative spillovers. Throughout the Indonesian presidency, the G20 will advance concerted effort to counter risks and support vulnerable countries, including through maintaining a strong and effective global financial safety net, continuing the work on debt issues, building a better understanding of the analytical framework for a policy mix that can provide guidance in pursuing growth and stability objectives, and exploring more diversified currency in trade and finance to support stability. As the global financial system becomes more interconnected, while the trend of digitalization is accelerating, the Indonesian G20 presidency also needs to progress discussions on central bank digital currency. Indonesia invites members, international organizations, and experts to work hand in hand in achieving a stable and resilient international financial architecture. Recover together, recover stronger.